Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 340th VideoCast podcast for the week ending April 23rd, 2026. Got a lot of great stuff to cover today, but as always, family first. This was a big week. Mimi had a fantastic weekend playing up in 16U Cal Cup. One game she had a hat trick, by the way. She had some incredible goals, a 5-meter penalty shot. Meanwhile, Annabelle had an amazing weekend in St. Petersburg, Florida at the Orca Awards, which is like the ESPYs of age group swimming. She got to train and befriend other top age group swimmers from around the nation. She caught up and recreated a throwback photo with Olympic record holder Bobby Fink, whom she first met when she was 7 years old. I remember that in St. Petersburg, Florida. She won a mentoring session with Olympian Tori Husk, and she won USA 11-year-old Female Swimmer of the Year. We are so proud of you, Annabelle, all your hard work. We are so proud of you, Mimi, for all of your hard work on the water polo side, and super excited for them. Made the move out here for them to pursue what they wanted to. They pitched us to move out here, and we said, let's go. And they are taking full advantage of it, and we couldn't be prouder of all the hard work they're putting in. So there's Annabelle with her Orca Award. There's Caitlin with Annabelle. Beautiful photo. That's me. I got some golf. One round in this week, which is pretty awesome. And that's with Bobby Fink. So that was just a few years ago, 7. So almost 4 years ago with Bobby after he had come home with his medals from the Olympics. And this is him, Bobby, now with Annabelle. Pretty amazing how time flies. That's Annabelle at the awards. And here's some studio shots. They're all mixed in just to give you guys a little behind the scenes look of how it looks on set. This is the bottom line there. Big trip to New York. This is the green room. This is Charles Payne's show behind the scenes. What else? Oh, that's with Diane King Hall down at the New York Stock Exchange for Schwab. There she is broadcasting from the Schwab booth down there. There is Ashley Mastronardi at NYSE. This is the floor of the stock exchange. You can see here's what a normal trading desk looks like on the New York Stock Exchange. These guys are order takers. They do execution. Some high frequency trader. I know Citadel has a booth there, but most of these guys are executing just vanilla equity orders and derivative orders for institutional buyers. So that's pretty cool. That's in front of the New York Stock Exchange, never gets old. This is where we got married at St. Patrick's Cathedral about 18 plus years ago. And here's a statue from one of my favorite books of all time, Atlas Shrugged. And then we'll get Mimi's quick penalty shot here. Boom. And let's get down to business. All right, first and foremost, we've got a lot of incredible stuff. So Intel just reported, and I just went on Bloomberg TV to talk about it. So thank you to Kayla Arestivo, Katie Greifeld, and Romaine Bostic for having me on. We're going to listen in here.
The number to watch, $74.88. That was the record high that Intel set back in August of the year 2000. Here in the after hours trade, those shares are now trading above that level. Whether it carries over into the cash session tomorrow remains to be seen, but the knee-jerk reaction to that earnings report from Intel is positive. Thomas Hayes joins us right now. He's the chair over at Great Hill Capital, which owns shares in the company. I know you got to be feeling good, Tom, given the phenomenal run-up that we've seen in this company. I guess the big question for you, does it continue?
I think it's going to continue over time, Romaine. I got to be honest, this has gone from despondency to euphoria in a very short period of time. We own a lot of stock from the low 20s and the high teens, and it's run a lot in a very short period of time. We came into this print a little bit nervous given the multiples on the year, 118 times this year, 59 times next year, but that's all short-term noise. The key is betting on the jockey with these turnarounds and lip Lip-Bu has that proven track record of success. We saw it in Cadence Design Systems. He had a 68 bagger after coming in when the stock was down 86%. So it's hitting on all cylinders. Everyone's talking about earnings. Everyone's talking about revenue blowing the doors off. What about margins and what about cash from operations, Romain?
Yeah. Well, I do want to ask you about leadership here because, it's been, about a year since effectively he came into the picture. And there were, let's be real. When he was announced, there were a lot of people that were kind of like not really enthusiastic about it. What's the difference between him and what Gelsinger was trying to do? Because, Lip-Bu is basically running the same company that Gelsinger was running, but clearly something has changed over the past, 9-10 months.
Yeah, well, look, the board got antsy because the stock price was down. Gelsinger delivered something that everyone said couldn't be done, which was 5 nodes in 4 years. So he basically got Intel to the 10-yard line. The board had approved all of that spending, but the stock price was down. So they had to have a sacrificial lamb, and that was Pat Gelsinger. Lip-Bu comes in with this proven track record of turning businesses around at the 10-yard line, and now he's spiking the football in the touchdown. But, Lip-Bu a special guy. He gets things done. He was able to navigate the relationship with the current administration and got them clear that this was a national security interest, got the government investment, put the backstop in the business. And just like President Trump is out selling airplanes for Boeing, he's out there selling chips for Intel. And those orders, as you're seeing the partnerships, whether it's Elon Musk with his $25 billion project in Austin, whether it's Google partnerships, whether it's potential Amazon packaging, everyone is starting to direct orders to Intel, and I think we are early days. We're seeing it in the guidance, we're seeing it in the margins, and we're seeing it in the trends. LLMs and LLM training was all about GPUs. Agentic AI and inference is all about CPUs. And Intel is a leader. It was referenced as much in the Taiwan Semiconductor earnings call with the CEO referencing the seriousness of Intel as a competitor.
So it's interesting, to hear you talk about the fundamentals. Say we're in the early innings. Do you think that that's already priced into the stock? Because, we're not yet at that record high reached in August 2000, but boy, we have come a long way up, about 80% year to date so far in 2026, higher by a similar magnitude in 2025. It has just been a stunning run, Tom.
Yeah, Katie, look, in terms of what they've delivered, this stock is insanely overvalued from a guy who owns a lot of the stock. In terms of what they're going to do, it's really inexpensive, even at these levels after hours. So in the short term, could it be a little bit overheated and have to consolidate these gains? The taxpayer is up, it basically has a 4-bagger. It's going to be up close to, 250, 300%. We'll see where this thing settles out over the next few days. So we could certainly see some consolidation as we get quarter after quarter of improved margins. There's a lot of room to run on margins. Taiwan Semiconductor last year, 55% gross margins. NVIDIA, 75% gross margins. Intel, 36%. So yeah, we had 39. We're going to go up over 50 over time. But here's the name of the game. They are a leader in an area where their problem is not demand. They've got demand as far as the eye can see. It's going to be a question of capacity. And I think Lip-Bu is the guy that's going to be able to deliver on that capacity over time. And all the partnership investments that have come in, whether it's SoftBank, whether it's the U.S. Treasury, whether it's NVIDIA, we're going to see more and more of that because the administration is going to push it.
Well, Tom, just quickly here, we have less than a minute left with you. I want to bring you a question that we were just talking about with Angelo Zeno. You mentioned CPUs, obviously a big beneficiary to Intel right now. But then you think about the competitive landscape. You have NVIDIA now in this space. We know AMD is there as well. How do you factor that in?
Here's the difference between NVIDIA and Intel. NVIDIA's business model relies on the kindness of strangers. NVIDIA's success is only as good as Taiwan Semiconductor's ability to deliver capacity for them. Intel, in some sense, has some control over their own destiny by how fast can they get production internally online. And that's really going to be the difference and the differentiator moving forward. Everyone in the rearview mirror has been chasing NVIDIA. I think the story of tomorrow is Intel.
All right, Tom, really great to get some time with you. That is Thomas Hayes. He is the chair of Great Hill Capital, talking us through those Intel results. Certainly stunning to see that stock perform after hours. We'll see if it holds through tomorrow's open.
And we're back. And then on Monday, I had the privilege to join the great Charles Payne on Fox Business. Want to thank Nick Palazzo and Charles Payne. We're going to listen in here.
All right, so one of the biggest movers in today's session is Top Build. That's the name of the company. They're being acquired by QXO. And my next guest actually gave us QXO about a year ago. And I got to tell you, it's been a grand slam. So let's bring in Thomas Hayes, chairman at Great Hill Capital. First and foremost, so I'm doing my homework last night. And I'm like, okay, I got to give Thomas props on QXO. And all of a sudden, they make big news today with this acquisition. Are you still holding?
Yeah, for 100% we're holding. We have this a big tranche at 11, big tranche at 13. This deal, post-deal, will be $18 billion of revenue and $2 billion of EBITDA. Brad Jacobs' target is $7.5 billion of EBITDA, $50 billion of revenue, so a lot of runway. Second largest building supplier now, publicly traded building supplier. You want to bet on Brad Jacobs because if you did United Rentals,
you just read my mind.
200 bagger on United Rentals, 50 bagger on XPO. We absolutely love this story. 4 million housing shortage that he's going to supply for.
And also his book, the billion, how to be a billionaire or something like that, right? So
how to make a few more billion.
Yeah, how to make a few more billion. So management is really important to you. I want to quickly on the manufacturing picks because you also like Boeing and GXO. Yeah. I'm looking at Boeing hard. I'm spying it really hard. For years it was the stock I would have never sold. Then after the two crashes, and then the way they handled that was ugly. And then, of course, the plane situation. Are they in the clear here?
They are in the clear. Kelly Ortberg is actually an engineer. They had a salesman running the business. Doors are no longer falling off the planes. This is a good thing. They've got a $600 billion backlog, just turned free cash flow positive, record revenues. No one wanted it last year at $135 when we were pounding the table. They're going to want it this year, and Trump is going to come home with a deal for planes from China. That's going to be the next leg higher in Boeing.
What's interesting is when everyone's talking about during the tariff battle and that China didn't need America.
Yeah.
And and Xi is flying a Boeing.
Yeah.
President Xi flies in a Boeing.
That's
right. They may not need some things, but they do need our planes.
Comac delivered 20% of the planes that they promised last year, and it only flies like 20% of the distance. It's a complete clown show over
right.
Yeah.
Let's talk about market positioning. So you're saying tune out short-term news, be more selective, and we say more gas is in the tank. What does that mean?
Okay, so we've had this huge run off the lows. There's still more gas in the tank because CTAs were 80 billion short. Now they're 14 billion long. They usually peak out about 76 billion. That's commodity.
So the pendulum is swung, is in the middle of still swinging.
They're still chasing institutional managers' highest cash levels still since May of 2025, and retail investors' record selling of leveraged ETFs in the hole. So I think we're going to get a little bit more upside, and then they always open the trap door for the Johnny-come-latelys. It'll correct 3, 4, 5%. But I think this is going to push higher. Fundamentals are strong. Estimates keep going up, so you got to be participating, but you got to do so selectively. Don't buy the things that have ripped higher. Buy the things that are just starting to go.
All right. And speaking of strong, you say that despite the sentiment, and I talked about this in the first block, that the consumer is strong, right? We want to bring up, for instance, just how uncanny it is when these consumer sentiment numbers go down and the market typically turns up.
Yeah, it's unbelievable. The lowest consumer sentiment since COVID, since the great financial crisis, since 2000. If you buy during these periods of consumer sentiment being down, you are rewarded handsomely. As a matter of fact, consumer discretionary relative valuation to the S&P 500, the lowest since the 2022 lows, and before that, the great financial crisis lows. You got to bet on the consumer when they have a job, and right now, unemployment is still at 4%.
Do we have that chart? I think we had the chart in the meeting. Okay, we don't have that chart, but I was going to back you up on that.
Yeah, for sure.
All right, let's just talk about where to make money then, because it's a big area. You always look for these names that are just, VF Corp. You always look for these names that are sort of beaten down and people have given up on.
That's right. Turnaround Tom. So first thing is solvency risk. So Bracken Darrell came in, he paid down the debt, he sold off Supreme, he sold off Dickies, paid down $2 billion of debt. This guy, if you'd bet on him when he took over Logitech, his last turnaround, $1 million became $26 million in 8 years. He's applying the exact
He could apply the same approach to Logitech that he can apply it here?
Absolutely. As a matter of fact, they're returning to growth. 10% of their book was in growth last year. Now 75% of the book. The only thing weighing it down is Vans, and Vans is turning the corner. Search activity is up 30-something%.
On Vans.
On Vans, it's coming back. And that's going to be the final thing that takes gross margin back up to $55. This is going to move back over $50 over the next few years. You want to bet on Bracondale.
All right, before I let you go, let's talk about Papa John's, right?
Yes.
And this is a name that, you know, it was on fire for a long time, had a lot of problems. We all know about the problems. But again, you start with the value proposition begins with management for you.
No question about Todd Penegor. He came from Wendy's. He turned around Wendy's for Nelson Peltz when he was doing that. A 3-bagger at Wendy's. He took it from the number 3 burger chain to number 2. He beat Burger King. He's applying the same principles, digital principles, with Papa John's. He's refranchising some stores to increase the margin, shutting down unprofitable stores. International is growing. And by the way, he brought in the guy from Domino's who did the whole digital. You know, Domino's has been a huge growth stock for the last 15 years.
One of the biggest stocks in history.
So he poached that guy to run the exact same digital reward strategies at Papa John's. Watch what happens to this over
How long would you be prepared to hold this? 3 years?
Our average holding period is 3 years, but they've got a bid now from Earth Capital, a Qatari fund, to take it out at $47. Same guys who bid $60 last year. They don't want to sell because the upside is at least double over a few years.
Great stuff.
Yeah, thanks so much.
Right.
Appreciate it.
Perfect timing, by the way. All right. Hey, coming up, Jeff Bezos, he celebrated.
And we're back. And then on Tuesday morning, I was on Varney for the whole hour on Fox Business. Want to thank the whole crew, Maggie Edwards, Lauren Simonetti, and the great Stuart Varney. We're going to listen in here.
So we have some green on your screen, especially the Dow looking good, up 200 points, Nasdaq up 67. Tom Hayes joins me now. You know, this rally, it's really something else. It's rapid, a very rapid recovery. How far does it go?
We've got more gas in the tank, Stu. Markets climb a wall of worry. And historically, when you see these 10 consecutive day rallies, 6 months later, the market's up on average another 11%. When you have 2 consecutive weeks of 3% plus gains, on average, the market's up 9% 6 months out. So there's a lot to do here. And the market's looking through this short-term noise, and it's looking at earnings. And earnings have been really good, up 13% earnings growth so far in Q1. Estimates continue to go up for 2026 and for 2027. So there's a lot to like here. But don't buy the things that have super ripped higher. Buy the things that are just starting to rip higher. Because why? Institutions are offsides, highest cash levels since last May. Retail investors sold in the hole, unfortunately. And CTAs, they've got another $50-60 billion of buying power.
So you're on board with this extra rally that's coming?
Selectively with great stocks that are at good prices.
You're not just going on historical relevance. You're saying, no, I, Tom Hayes, believe we're getting another 11% in this market.
Not another 11% over time based on data, and I'm looking to buy good businesses at great prices, not just the indices broadly.
Okay, so your heart is in it. I'm trying to get
100%, Stu, always.
I think you're staying with me for the hour, aren't you?
All right, I love that.
Good luck. Now show me the stock price of Apple, please. It's down $1.80, that's all. The CEO, Tim Cook, stepping down. He's been there 15 years. He's going to become Apple's executive chair. John Ternus, Apple's senior vice president of hardware engineering. He becomes the new CEO in September. Tom Hayes with me. What do you make of this shakeup? And would you buy Apple stock now?
I wouldn't buy Apple stock now. However, I think it's a great company, and this is a passing of the baton. It is not a passing of the buck. Tim Cook will stay there as executive chair. He'll still be overseeing operations, and basically we've gone from Tim Cook, an operations guy, back to a product guy like Steve Jobs. This is a good thing. They need some innovation. They need some new handsets. They need some things to excite people. Tim Cook was very successful in maintaining the garden ecosystem. There were a lot of threats to that ecosystem. He was able to maintain the walled garden. This is a very good time for the transition.
Turnus has got a tough job. He's taking over from a legend who in turn took over from a legend, Steve Jobs. That's
for sure. Apple will be fine.
Oh, I'm sure he will. Stay there, Tom. Tom Hayes brought his stock back. Well, really, this is a real change of subject. And we're going from Cuba and Iran. We're going to the stock market, which is really serious stuff. He likes PayPal. Tell me why.
This is one of the greatest comeback stories in U.S. stock markets right now. Record revenues, record free cash flow. By the way, the 2 top payment apps in the U.S., you know what they are? PayPal and Venmo, 439 million users. They're buying in 10 to 50% of the company, 10 to 15% of the company with buybacks every single year. Venmo's growing at 20%. Buy now, pay later's growing at 20%. We love this stock.
I can see.
Yeah.
All right, Tom, thanks very much indeed. Check futures real fast, please. I see green. Dow's up 250. Nasdaq's up 60 points. The opening bell is next. And I think this story is extremely important. Amazon is expanding its investment in Anthropic. They're spending how much? A lot.
Yes, total $25 billion, $5 billion initially, and then it grows up to $25 billion if certain milestones by Anthropic are met. Total lifetime investment by Amazon into Anthropic now up to $33 billion. This is circular. In return, Anthropic has committed to spending up in the next 10 years about $100 billion on AWS technologies in Amazon.
Jeez.
Circular, but investments nonetheless.
We're talking seriously big numbers here, and Amazon's looking very good.
Yeah, I love it. Andy Jassy, brilliant move. Keep Anthropic on AWS. Use our chips, use our servers, use our services, and this is the way to do it. And they stay at the cutting edge. They're telling the market we are staying at the cutting edge of AI. We are not going to get left behind. Something that Apple has struggled with a little bit in recent months.
Anthropic is the cutting edge of AI at this point.
Today, we'll find out next week.
Fair enough. Fair enough. Here's a simple question,
honest.
and I know you've got an answer for it. How much does a single-day ticket at Disney cost?
Okay, are you ready for it?
Yeah.
Brace yourself for all the grandkids. Over $200 we're hearing for the first time at both U.S. resorts. A single day ticket. That is the first time. So as of April 2026, the top tier pricing demand to $224 at Disneyland, $209 at Walt Disney World. And holiday pricing for 2027 is expected to climb. Magic Kingdom, those peak tickets are also projected to hit, as of now, about $219 in early 2027.
Hold on a second. Tom Hayes,
Yeah.
Disney is your stock pick, your second stock pick of the day.
I love it. The magic is on sale. Warren Buffett always said you can determine the value of a business by their pricing power. What they're telling you by raising prices is we have a near monopoly on happiness at the parks. This used to be a media company that owned parks. It is now a parks company that owns media. The new CEO came from the experiences business. It's the highest return on invested capital business, and they're investing a lot more. $10.8 billion of free cash flow last year, up 18%, a record. And the stock is trading at a low historic multiple.
That didn't sell you?
I'm still on about $200 single ticket day price. I mean, that's ridiculous.
I know.
Buy the stock instead of the tickets.
I mean, what do you
better
do?
return.
What do all regular people do? Children and grandchildren. What are you supposed to do?
I know.
You can't afford that.
The company, for their part, they do say that they're trying to make it affordable and that they're trying to keep the doors open to regular families. But it is hard, and it's out of reach for a lot of middle-class families.
They're putting profits before people, as the left would say.
Well, I'll tell you, when I was growing up, I would save up for events like this. So,
You saved
Yeah.
$200.
yeah.
Good luck.
I was a golf caddy, Stu. Grew up in New Jersey.
So
Carried
was I.
golf bags. There you go.
That's right. Right. Taylor, thank you very much
You
indeed.
got it.
And you stay there.
All right.
Coming up, Tom, when is Walsh going to lower rates?
I think he's going to do it sooner than John thinks because he's going to reduce the balance sheet at the same time. So he'll take liquidity out of one side of the bucket. He'll add liquidity on the other side of the bucket.
10 seconds to respond.
Okay, if you reduce the balance sheet, that means higher interest rates at the longer end of the Treasury yield curve. Mortgage yields go higher.
Unless he works with the Treasury and implements an Operation Twist, and they start buying in the long end of the curve.
We've got a commercial break coming up. You never interfere with a commercial break, ever. Right. Great stuff, gentlemen. Thank you. Coming up.
And we're back. Then on yesterday, I had a chance to join the Big Money Show on Fox Business. I want to thank Anastasia Cavanis, Brian Brenberg, Taylor Riggs, Jackie DeAngelis, Dagan McDowell will listen in here.
Welcome to the Big Money Show. I'm Dagan McDowell, along with my co-host, Taylor Riggs, Brian Brenberg, who got a haircut.
Check it out,
apparently.
Taylor loves it. Ask her about it.
Did he do it himself?
What?
Jackie DeAngelis. And with us for this hour, Great Hill Capital Chairman Thomas Hayes.
Tom, agree or disagree with me when it comes to these markets? Dagan, in the last couple of days when you were away, I said I am just so impressed by the resiliency of these equity markets, of a market that was at record highs in January. We had a big 3-week reset in March, and then we have come back and then some and stronger. And so to me, this is a market that saw that correction in March as a really good, healthy reset in terms of sentiment. People buy, and then those highs beget new highs because you've had that big reset in March. And so I think the rally, if the fundamentals remain intact, which so far they are, continues, I think, because people are really excited. We've talked about earnings season, how strong this has been. I know that we'll talk about some of those companies later. There's also another really interesting note I read about how, day to day we can say the market's higher, the market's lower, but I think long term in a portfolio, you are looking at countries and companies that see these chokehold points in the Middle East and say, maybe I need to rethink my supply chain. Remember in COVID, we all looked at China and we thought, okay, maybe I need to nearshore or reshore. And I'm wondering if companies are thinking, how do I rethink supply chain so that I'm not subject to this if this continues to go on? Does that mean that power, resources, commodities remain relevant to investor portfolios if these are going to be the companies that say, I'm going to long-term change the way I think, the way I import, the way I do business? And if I want that to be in the U.S., then what does that mean going forward?
Yeah, I think to your point, Taylor, this is going to accelerate reshoring. It's going to accelerate the industrial renaissance. We talked about building out data centers on your show last night. But the blockade from a market standpoint was brilliant. It's called checkmate. They've got one piece left on the board. It's the king. And they can keep moving around while we have 12 pieces, but eventually we're going to get them into the corner and they're done. They're losing $500 million a day. Time is on our side, not their side. They've got widespread protests, anti-government protests happening everywhere in Iran. And the market said, we're going to look through this. Already, around 7 to 9 million of the 20 million barrels has been rerouted. U.S. production is up. So we can withstand this much more so than they can withstand this. Markets figured that out. Bet on American energy. We're energy independent. They got that right. The drill, baby, drill 5-6 years ago was the right call, and look where we are today.
Man, I'm with Tom today.
Yeah.
I am with you on that.
I love it.
So what is a ceasefire? 3 to 5 days more, did he say? Is that kind of what he's talking about? How about on the 3 end of that? And just go into the Strait and decimate what they've got some Navy left, decimate that, choke off the money, decimate their Navy. And then I'm going to say it again, and I know Larry's going to come on the next hour and he's going to poo-poo this. But I think you got to get, from the standpoint of confidence for shippers to start moving stuff through the Strait, I think you got to get these weak-kneed Europeans to the Strait, and they got to help a little bit, because if they're courageous enough to go there, then I think other people are going to be courageous to go through there, and it'll help. Okay, I don't love the Europeans. I think NATO's fallen flat on its face on this, but it would be helpful to get them there.
Yeah, I think there's no accident that it's 3 days, because that takes you to Friday after the close. So get a deal or get bombed over the weekend is basically how it's going to go. So so we hold all the cards here.
So we have a lot of people weighing in, but again, it looks like there are reports that the government could own up to 90% of this company and maybe potentially pull it out of bankruptcy. Tom, what do you think?
I think Biden screwed this company with shooting down that, because the private sector would have handled it. They would have had that area. United doesn't want them in business because they'll take over those routes. And President Trump is doing another one of his deals. A lot of people criticized Intel when we were buying it down at 18 and 19 bucks. It's now at $60, $65. The taxpayers made a fortune, over 200% in less than a year. So if he does this deal, you save 14,000 jobs. The company is headquartered in Florida, by the way. That has 14,000 jobs in the company. So I wouldn't be surprised. He has the cachet to go do this now, because he said, look how much money I made the Treasury on Intel. I'm not a huge fan of it.
But does that make it right?
We haven't sold Intel, have we?
Well, we shouldn't sell Intel.
No, answer my question. We haven't sold Intel.
Yeah, because it's going to be a 5-bagger,
so then we
not a
haven't made
3-bagger.
jack. We haven't made jack unless we sell it.
Take some
Number
profits.
one.
And then do you have to pay capital
I don't think you want to take profits here. I think Liputan's taking this to the promised land.
The government.
Yes.
We're still owed what I use this number all the time. How many billions from
So many billions.
General
For
Motors?
GM.
I would say this is how it's different. Intel was a national security issue. Okay, we can't have all of our chips made by Taiwan Semiconductor. Frontier, if they go out of business, life goes on. Okay, however,
Spirit.
Spirit.
Not Frontier.
Spirit goes out of business. However, the government is the one who put them predominantly in this situation because that merger would have made a lot of sense.
I hear you. But is Wall Street flashing a warning sign from Warren Buffett's favorite gauge? It's the so-called Buffett indicator, which compares total stock market value to the size of the U.S. economy. Well, that just hit a record. 232%. To give you some context here, anything near 100 is considered fair value. We're more than double that. Berkshire Hathaway has been sitting on a massive cash pile north of $370 billion. Is this a message that the market is too expensive?
This chart has been circulating Twitter and social media forever. The only person who's not talking about it is Warren Buffett because it's wrong. It's been around for, he talked about it in 2001 when it was valid. Here's the problem. You have U.S. market capitalization. Here's the problem. Over the last 25 years, a lot more of the revenues of the S&P 500 are international, over 40%. For the hyperscalers, it's 50 to 60%. So if you want apples to apples with the numerator and the denominator, what you need to do is put S&P relative to global GDP or back out U.S. revenues and earnings from the numerator. So do U.S. market capitalization X international revenues and earnings, and that takes the ratio down to about 140, 1.4 versus 2.3 when you divide it. So,
well, 1.4 would still be high.
Yes, but the composition of the S&P market capitalization, we've gone from CapEx heavy and industrial heavy to CapEx light. So on an adjusted basis, it's probably reasonable. I'm not saying the stock market's cheap. I think about it as not a stock market, as a market of stocks. There are buckets of the stock market. There are buckets of the stock market that are exceptionally inexpensive right now, and there are buckets that are expensive, and right now in the indices you're weighted more towards the expensive stocks.
Robert Bryce wrote an entire blog post about Fermi, the company. Last Friday, that company announced that its co-founder and CEO, it is a power for AI startup, had departed his role as the chief executive officer. Quote, this is Robert Bryce writing, in a terse 8K filing, the company did not give any reasons for the CEO's departure, and it came 198 days after Fermi went public on the NASDAQ and London Stock Exchange. Public at 21, currently trading at 587.
By the way,
and he goes into what's happening at that company.
To your point, in March of 2000, there was an article that said, has Warren Buffett lost his touch? Because all these people were buying tech stocks, they were getting wealthy. What was Warren Buffett doing? He was buying consumer staples because they were down, the current yields were high. Procter & Gamble, Coca-Cola, boring companies. Over the next 3 years, when the NASDAQ corrected 80%, okay, he had one of his best 3 years of performance. He was positive while everyone else was negative. There are similarities right now to that period. You can't give away a lot of consumer staples stocks, and some of them are yielding 7%. So Buffett historically would be a buyer of that, whether you take, and I'm not endorsing any of these, General Mills, Conagra, Hormel Foods. Hormel Foods we own, actually, but a whole basket of them yielding 6-7%. As that, and these stocks get beaten down when there is that euphoria. No one wants defensives. They want Allbirds turning into an AI company, which is a little scary. We are in a midterm election year. We should expect a little bit more volatility going into the election. But as it relates to AI, we haven't even started to see the productivity gains that normal businesses are going to receive over the next few years. The 100-year-old manufacturer whose margins are going to go up 20%. So I think we're midway through. The key is, how do you play it? Do you play the AI cost centers like the hyperscalers that everyone's crowded into at high valuations, or do you play the AI beneficiaries like we're doing at Great Hill Capital, boring businesses that can have margin expansion?
It's very Buffett-y.
100% Buffett. He's my mentor. I've read every single word Warren Buffett has written, and I think he's changed more than my life. I think he's changed millions of people's lives by giving common sense advice and leading by example.
I just think it's funny that literally no one believes this Buffett rule. Nobody trades on it, right? Does anybody trade on this? Does anybody believe it? Does anybody say this is my operating principle? And yet the financial press has got to trot it out periodically to tell everybody we've got problems. Nobody believes this stuff. It looks more like a rhetorical weapon than it does a decision-making criteria.
It was correct when Warren Buffett was talking about it, but you haven't heard
25 years.
25 years ago.
Thank you. Thank you. Thank you, financial press, for 25-year-old advice.
Tom, here's GE Vernova. This is what they say this morning on their earnings call. They say, we beat on the top and the bottom line, but orders surged 86% within their electrification division. That segment just booked $2.4 billion in equipment orders for data centers in the first quarter alone. That exceeds all of the orders that they had for 2025.
Yes.
If that doesn't show us real companies that are seeing AI data center demand, I don't know what does.
AI beneficiaries versus AI cost centers. So that's number one. You know, we own a company called Generac. They do home standby generators. Well, guess what they're doing now? They've got almost $1 billion backlog for backup generators for data centers. So there's going to be a lot of pass-through. This is the biggest productivity shock since the internet, the advent of the internet, the productivity. And the jobs are going to shift. First off, if you build things with your hands, if you're an electrician, if you're a plumber, if you're a drywall, your wages have already gone up 20 to 30%. They can't even BlackRock can't get enough workers to build out all the data centers that they want to build. So those people are fine. Everyone else will shift. You know, I play golf in California. There's this beautiful $7 million house being built by an influencer who's 21 years old, Lexi Rivera. And you think about where would she be before the internet? Where would so these are industries that come up from new technologies that would never exist before. There's friction in the short term, but in the long term, the standard of living across the board gets slightly better for everyone.
Wellness, quote, real estate and mental wellness are surging, highlighting a lifestyle shift. We've had a lot of in the break conversations on this show, Tom, on all this stuff. And there is so much energy around, well, I don't even know how to explain most of it, but people are drawn to newfangled ways to promote wellness.
Yeah, I mean,
the fact that I said newfangled tells you that I am definitely not at the edge of this curve.
Yeah, well, Ralph Waldo Emerson said many years ago, health is the first wealth. And I think you're seeing it across the board from wellness real estate, which talks about better air filtration, better water filtration, circadian lighting. The home builders will figure that out. To food companies who have had to adapt with GLP-1s. People lose weight. They want to eat better foods. They want to be more active and more healthy. If you look at Diageo, their number one selling or growing group is Guinness Zero, which has no alcohol and no calories. Companies like Hormel have had to shift to more protein-centric products like sausage, like
they put
peanuts,
protein in coffee now.
They put protein.
They don't put any beer in beer, but they put protein in coffee.
That's exactly
and
right.
Collagen. And collagen.
Collagen and what?
Is all the rage.
Yeah, I think the saying time is more valuable than money. You can always get more money. You can't get more time.
Right.
Well, the baby boomers have the money and they're trying to buy the time.
Yes.
And that's what this trend is all about. And we're back. And by the way, on the Varney and on the big money, those were for the full hours. So Zach went in and cut out just those sections so you don't have to listen to the full hour. That's why it keeps changing topics so quickly. I think the most important topic I just covered on the Big Money Show was the Buffett indicator, which all these media outlets are saying it's 230%. You know, Buffett said 25 years ago, if it gets above 1, the world is coming to an end. The numerator and the denominator have changed. And if you listen to what I said, it will put you at ease. Bottom line, on Fox Business did that one for the first time as well. Want to thank Samantha McCormick. As always, Brian Brenberg and Lydia Hu. We're going to listen in here.
Is the AI boom an energy boom?
I think we're seeing a productivity explosion right now because of AI. I think that we're in the early stages here of a productivity revolution that's being driven by AI.
We'll discuss with Thomas Hayes. He's joining us live right here at the desk. That's next. Not fair to do stories like that at
No.
dinner time. Come on. All right, the AI boom isn't just happening in the cloud, it's happening on the ground. A massive wave of construction, power demand, and investment is rapidly transforming America's energy and industrial landscape. David Sachs says the scale of what's coming is just beginning.
You're seeing a tremendous boom in construction and data center construction to power this revolution, and that is also driving an energy revolution. We're seeing tremendous growth in CapEx around both energy and the chips in the data centers. It's also driving reindustrialization in the U.S. So I think that we're in the early stages here of a productivity revolution that's being driven by AI.
Joining us now, live at the desk, Great Hill Capital Chairman and Managing Member Thomas Hayes. Thomas, so great to have you here. What are your thoughts about what Mr. Sachs is laying out? Are we on the doorstep of a productivity revolution?
Mr. Sachs is right a lot, and he's right about this as well. AI may live in the cloud, but it runs on natural gas and soon to be uranium. You know, we've spent the last 2 years obsessing about microchips. We're going to spend the next 5 years obsessing about megawatts, and that's the whole game right now. These hyperscalers are absolutely hitting a wall. They're going to have to bring their own energy.
So you got communities around the country. We've talked to some folks in Missouri and Wisconsin, and you've got these towns where city council says, yep, let's do a data center. And the people say, I don't know if I want one for exactly what you're talking about. They worry about their energy prices going up or, you know, kind of their water reserves running out. What's your response to folks in those towns who are saying, I don't know if we've got the infrastructure for these things?
Yeah, I think President Trump addressed this when he said it's bring your own energy. You're going to have to pay for your own energy. And these hyperscaler companies are going to be forced to become power companies. They're going to have to set up their data centers near natural gas reserves. We own a company at Great Hill Capital called Comstock Resources. They're doing a joint venture with NextEra Resources. 5 gigawatts, $16 billion project. They're going to be the sole provider of energy. 1 billion, a lot of natural gas every single year for the next foreseeable future, up to 2031. Billion cubic feet per day of natural gas for that. So we're going to see more and more of this. But what's really happening is that it's creating high-paying jobs on Main Street. You can't get enough electricians, enough plumbers, enough drywall, and their wages.
Okay, now wait a sec. You're telling me this, but you've got guys like Elon Musk saying we need a high universal income. We need like a high replacement income for people whose jobs are destroyed by AI. Are you saying that Elon Musk has got it completely wrong on this?
Well, I'll say this. BlackRock can't get enough workers for the amount of data centers they're putting up. The wages are going up on Main Street for these type of skilled workers 20 to 30% already. Not one day it's going to happen. So there are a lot of people that are sitting in their ivory towers saying this is bad for everyone. You know who it's good for? Everyday Americans who actually do regular jobs that actually build out this infrastructure, build out the world. This is the biggest infrastructure project taken on in the United States since the interstate highway system built out in the 1950s. So many great high-paying middle-class and upper-middle-class jobs are going to be created. If you're sitting in an ivory tower, maybe you should be worried about AI, but if you're actually building stuff with your hands, we need you, and you're going to get paid for it.
But then why do you think there is so much, I guess, caution or skepticism around AI and this revolution? I mean, even today during the confirmation hearing for Kevin Warsh, you heard that from some members of the panel, some sitting senators asking questions about AI, being a little bit skeptical. And you just hear this and see this in surveys, folks being worried about replacement, that they're going to lose their job. Where is there a disconnect here? Is there some messaging issue? What's going on?
It is the fear of the unknown. People are afraid of losing their jobs, et cetera. They haven't seen the return on invested capital yet. We've seen CapEx as a percentage of operating cash flow for the hyperscalers is over 90%. They could turn free cash flow negative by the end of the year with the amount of investment before they see the return on invested capital. So you're going to see some volatility in these stocks until they start to see the return. But once you see the return, they're going to have these moats and they're going to be cash machines once again.
I love when we start talking free cash flow. Music to my ears. Exit question for you. I'll throw you a curveball. Apple's got a new CEO. Tim Cook's out. They've got a hardware guy in, and the knock on Apple has been they haven't figured out AI.
Yeah.
Do you think the new guy is going to help an old company like Apple become an AI superpower?
I think he has to. And they've always done it right. They let everyone else fight it out in the beginning, let them kill each other, and then they pick up the remnants and they run with it. So I think this will be the right guy. You had the product specialist in Steve Jobs. Then you had the operations specialist. We're back to the product specialist. They do need a breakthrough in technology, and I think this is the guy.
Okay.
A lot
Good
to watch
stuff.
for. All right, Tom
Hayes. We always learn so much from him.
Every time. He's the best.
Good to see you, Tom. Be sure to catch Tom tomorrow on The Big Money Show. Larry Kudlow will also be there beginning at noon Eastern right here on Fox Business.
And we're back. Got a chance to talk about Comstock Resources. Then Schwab Network on Monday morning. Join my great friend Diane King Hall, and thanks also to Caitlin Christ. We're going to listen in here.
Joining me now to dive into the resilience of these markets, the U.S. consumer, and how investors can capitalize. We want to welcome in our next guest. That's Tom Hayes, founder and managing member at Great Hill Capital. Tom, thank you so much for joining us once again. You say tune out the short-term noise and headlines, and it does feel like the market is doing that to some degree because we're a little soft this morning, but I was expecting to see more pressure when I saw the headlines this weekend. Your thoughts?
It's like Groundhog Day. Every weekend the market's down, and then by Monday and then it will probably close green. I think this is all noise. I think what you have to do is set that aside, be selective in these environments, and look at the underlying business fundamentals. And what that means is, how is this going to affect their ability to generate free cash flow over the next 6 months, 12 months, 18 months? And then once you can do that, you can say, okay, now when life gives you lemons, you make lemonade. Where has most of the pain been felt due to the short-term headline shock? And we're seeing a lot of that, particularly in consumer discretionary, trading down relative to the S&P to the lowest relative valuation since the great financial crisis and the 2022 lows. So we want to look in that area in particular because consumer sentiment is at record lows.
It is.
And historically, you've been paid very, very handsomely to step in during those periods.
Do you also wonder if there's some FOMO, especially when you think back to a year ago when so many investors kind of got caught flat-footed with the recovery?
Yeah. This was absolutely a coiled spring market, and what you see is CTAs now, they were record buying. You went from record puts to record calls in a week. CTAs went from negative 80 billion to about plus 14 billion. They usually peak out around 76 billion. So they're still off sides. There's still some buying power. Institutions' cash level is the highest since May of 2025. We saw that in the Bank of America Fund Manager survey. And retail investors dumped leveraged ETFs at a record rate never seen before in the last week and a half. So a lot of people are still off sides. That's why you saw them buying all the call options to play catch up. My guess is, we push a little bit higher and then we dump a little bit to get the Johnny-come-latelys. That's the way the market always does it. It's all the ones who didn't believe it on the way back up. They finally get forced in capitulation, and then the market corrects 3 or 5% just to knock them out before moving higher.
Now, you say history suggests strength begets more strength, but you also say be selective. When you say be selective, can you define that?
Yeah, so I like to buy higher quality assets in the most dislocated and hated sectors at the moment. And right now, if you look at restaurant stocks, if you look at consumer discretionary stocks, anything related to the consumer has been baby thrown out with the bathwater. And if you look beneath the surface at the underlying businesses and the fundamentals, if you take like a VF Corp, okay? This is like a Nike trade almost. But what I love about VF Corp is there are a lot more outs. So they've got North Face hitting on all cylinders, Timberland hitting on all cylinders, JanSport, Eastpak, Altra. What's weighing them down is Vans. You can't give away a pair of Vans, except it's changing, okay? So they've done these high profile collaborations, and they were on the fashion runways in France, and you're seeing search interest go up like mid-teens, quarter-on-quarter sequentially. So all of the channel checks are showing us that Vans is finally turning the corner, and the business overall is back to growth. They had 10% of the portfolio at growth a year ago. It's now 75% at growth.
Well, one question I have for you, though, in terms of its performance, the share performance so far this year, it's had some strength, and especially on a year-over-year basis. You still think there's an entry opportunity here?
For sure. Look, our average holding period is 3 years. So we entered this at $13 sometime back. It started to move again. And you want to bet on Bracken Darrell. His last turnaround was Logitech. He got in when the stock was 86% down. This is down from $60 in COVID. So there's a long way for recovery. His last deal at Logitech was a 26 bagger. If you'd put $1 million when he became CEO, you made 26 million over the next 8 or so years. So he's running the exact same playbook, targeting 55% gross margins. We think that's a better way to play it than Nike or something that's a singular play with limited outs. He's paid down $2 billion of debt with the sale of Supreme and the sale of Dickies, and now the business is back to growth.
Another one, this is tied to the consumer that you like, is Papa John's, PZZA, the ticker there. Now, year over year, it's up a little bit more than 20%.
Yeah.
Why do you still like it?
So
or why do you like it now?
Yeah, no, there's no question about it. This stock, it's the 4th largest pizza chain in the United States. Huge growth internationally. U.S. has been a little weak. 6,083 stores, and they've got a new CEO that's come in to turn it around. Todd Penegor, he came from Wendy's. He ran the turnaround for Wendy's for Nelson Peltz. He took it from the number 3 burger chain to the number 2, beating out Burger King, and he had a 3-bagger in the stock. So he's applying the same things. They brought the guy in from Domino's. Domino's has been a monster growth stock for like 15 years, who ran the digital, the app, the reward system. They're applying the exact same system now to Papa John's, and you're seeing it. You know, my girls have ordered it. I always do channel checks. I'll tell you, it takes us 11 minutes to drive to the store. We had a delivery. It came to our house in 9 minutes. I don't know how they did that. If they've got them,
read your mind.
I don't know if they've got them in
this is what they want.
Tesla plaids, but I don't know how they cooked it and got it to us in 9 minutes. It was absolutely insane. So.
And then another pick that's on your list. This is not the consumer, Cooper Standard.
Well, it's indirectly tied to the consumer because Cooper Standard is the leader in sealing systems, the rubber around the doors and windows of new cars, and fluid transfer systems. We started this position in May of 2022, around $5 and change. It shot up to, $45. It's now at $30. This is tied to new car sales. Ford, GM, Stellantis are their biggest clients. You got the average car on the road 14.5 years. You now have the tax deductibility of auto loans on U.S.-made cars, and you've got Warsh coming in lowering rates. So there's pent-up demand. There's all the millennials that need new cars, and the volumes right now are at $15 million unit trough. If you go back 40 years, every trough cycle is 15 million. Every peak cycle is 17 million. This business is going to earn $6 a share by 2028. So if you put a trough multiple on it, it's a $60 stock. If you put a peak multiple on it, it's worth over $100. And by 2010, they've taken $700 million of costs out of this business. We believe this business can earn $10 a share. So if it trades at 10 times, it's 100. If it trades at 20 times, it's 200. And that's not pie in the sky, because this was a $146 stock in the last peak, which was 2017, when they earned $7 a share.
Okay, we're going to have to leave it there. Only for time. Tom, I always enjoy talking to you.
Thank you so much.
Thank you.
Thanks for having me.
Appreciate that. That's Tom Hayes, founder and managing member of Great Hill Capital, with some names that you should have on your radar, your pick list today.
And we're back. And then we had the privilege to join NYSE Live, thanks to Mel Montanez and Ashley Mastronardi. We're going to listen in here.
Joining me now is Tom Hayes. He's the chairman and managing member at Great Hill Capital. Tom, welcome.
Thanks for having me, Ashley.
So we're 30 minutes away from today's session. What are you going to be focused on most closely?
Well, I think it's kind of Groundhog Day. You know, every weekend you see like noisy headlines. Everyone's nervous to go into the opening, and by the end of Monday, the market's green again. You know, so what? We took a ship. You know, it's like on to the rest. And I think the reason for that, Ashley, is the underlying fundamentals are very strong. Estimates continue to ratchet up. $323 for this year, $375 of earnings next year for the S&P 500. And strength begets strength. Historically, when you have 10 days of rallies, 10 consecutive days of rallies, 6 months later, the market's up another 11%, and you still have CTAs, commodity trading advisors, offsides. They were negative $80 billion exposure. Now they're plus $14 billion. They tend to peak at about $74 billion, so there's still some more catch-up trade there. Institutions still have the most amount of cash on their balance sheet since May of last year, and retail investors dumped leverage ETFs, not at the highest rate since COVID or the highest rate since the great ever. Okay, so there's this enormous amount of catch-up trade, which is why we saw going from record puts 2 weeks ago to record calls last week. That's people trying to get leverage to catch up. So my guess is we push a little bit higher, get absolutely everyone in, all the reluctant bulls, and then we'll pull back 3 to 5% because that's just the way the market works.
Well, on Friday before the show, we had heard that the Strait of Hormuz was opened. Then over the weekend, of course, the U.S. fired upon the Iranian cargo ship. How is the volatility impacting your investing strategy?
Yeah, it has zero impact. Our average holding period is 3 years. And that's what you need to do during periods like this is tune out the short-term noise and be selective, buying businesses and looking beneath the surface at the underlying fundamentals. So all this headline, the headline that we're going to get today, the headline that we're going to get tomorrow, the tweet that we're going to get on Wednesday, how does that impact how much free cash flow VF Corp is going to generate over the next 36 months? It's completely immaterial. They're either going to sell Vans or they're not. They're going to sell North Face till the cows come home. They're going to sell Timberland. They're going to sell Altra running shoes, the #1 trail running sneaker on the market right now, which you know is a marathoner maybe. And that's what we try to focus on. You know, how is that going to affect how many pizzas Papa John sells in the next 90 days? It has zero impact. So that's what we try to focus on. Yes, in the short term, headlines will impact price. Short term, the market is a voting machine based on price and emotions. In the long term, it has zero impact on fundamentals.
What are some of the biggest mistakes investors make during geopolitical uncertainty?
Well, I think two major mistakes that investors make. Number one, they bet based on their politics. Guaranteed loser, okay? Number two, they extrapolate the worst case scenario in a geopolitical event. And what we find looking back at history, going back 80 years now, is the market pricing tends to bottom 10% into the war. So if this war was going to last 365 days, on average, the stock market bottoms after the first 30 days. So you don't need an absolute resolution of the war. We do need oil passing through, although a lot of it's been rerouted and it's underestimated how much has been rerouted. We need energy prices to come down. But beyond that, if there's friction, if there's not a perfect ceasefire, the market will look through it, similar to how they've looked through Russia and Ukraine for better or worse, leaving that aside.
And earnings season kicked off last week. What are your takeaways so far, and what do you think we're going to hear for the rest of it?
We're getting better growth than we expected. I mean, 18% up to 18% earnings growth this quarter, that's big. Estimates continue to go up. And that's why I think the people that were caught offside, selling in the hole and now have to chase up with leverage, aren't really going to go away. Maybe we'll get a little wobbliness until we get some feeling of a ceasefire again or feeling of a deal again. But I think we could probably push higher for another few weeks. And when everyone's euphoric, then maybe take a few chips off the table if a shorter term mindset is what you're after. But for us, all this last 4 weeks was an opportunity to buy on red days, to own good businesses at great prices for the long term.
How much impact do earnings have on the major averages?
Everything. In the intermediate to long term. In the short term, sometimes it can be nothing because you can get geopolitical headlines, you can get tweets, you can get short term out of favor, you can get forced selling, structural issues in the market. But in the intermediate to long term, whether it's the overall indices or a company, in the long term, the weighing machine always wins, and that means price catches up or catches down with fundamentals. Like you've seen a lot of the stocks coming into this year, the shiny object high flyers trading at 100 times sales, trading at 100 times earnings. A lot of the software stocks, they got smashed, they got re-rated, and they're probably never going back to peak valuations for some of those that were trading at too high a valuations. So the fundamentals got too far away from the underlying value of the business, just as they get too far undervalued sometimes in corrections, and that's the opportunity to buy for the long term.
And retail sales data will come out this week. What is the state of the consumer right now?
They've never been worse. I mean, consumer confidence, you can't make this up, is worse than COVID lows, worse than the 2022 inflation scare, worse than the great financial crisis, worse than the tech wreck. And guess what? Historically, every time you've bought consumer discretionary, when the consumer was this despondent, you've been rewarded excessively. So that's the area that we're focused on, about being, circling back to being selective. Consumer discretionary on a relative basis to the S&P 500 has not been this low since 2022 lows, and before that, the great financial crisis. So that's where I want to be fishing, not where everyone wants to be. I want to be where no one wants to be, and then when everyone wants to be there, we'll help them out and lay off the shares.
And what sectors are you homing in on right now?
Yeah, so I want to be two areas. One, I want to be consumer discretionary. So VF Corp is one for us. We own Bracken Darrell's turning around that company. It's got Timberland, North Face, Vans is starting to turn around. This will be their first year back to growth in 2 years. So we like that story. We like Papa John's. Restaurants have been slaughtered on the basis of the consumer being kind of despondent, the consumer. But the tax refunds are up 15.6%. That's $36 billion coming into economy. I think the consumer is going to be going back to the restaurants, and we have a leveraged way to play it. 6,083 restaurants, number 4 pizza chain in the United States, huge international business. They've got the digital going well. They brought the guy over from Domino's. Domino's has been a huge growth stock. So I think we're going to see that. And by the way, Earth Capital, Qatari fund, just made an offer to buy it for $47 a share after they made an offer last year to buy it for $57 or $60 a share. So the stock's at $36. Either they're going to grow their way back to $60, $70, $80, or they're going to get bought out.
All right, Tom Hayes, a chairman and managing member at Great Hill Capital. Thank you for joining us at the New York Stock Exchange.
Thank you, Ashley.
Coming up, cybersecurity.
And we're back. And finally, we got a chance to join Yahoo Finance with Brian Sazi on Friday, thanks to Justin Oliver, Brooke DePalma, Inez Ferre, and of course, Brian. Listen in here.
And lastly, Allbirds, the stock rally is embarrassing, and I hope you haven't gotten sucked into this crappy company's madness, because it is absolute madness, and it is a crappy company. Here on my opening bid roundtable, Tom Hayes, Great Hill Capital Chairman and Managing Member, alongside Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. You know what? I'm just going to toss up this one to you there, my friend Tom. Allbirds, are you kidding me here?
I think the market is kidding you here. This looks like a meme. This is a complete train wreck. And this is what happens. This is a good note for people to observe. This is what happens when you chase shiny objects and you chase fads and you chase trends. You lose all your money. So after you lost all your money, they threw a Hail Mary and they say, well, did we say we were in the shoe business? We're actually in the, we're going into the AI business or whatever new business they say they're going to. If that doesn't work next week, they'll go into crypto mining. I mean, you've seen this movie before. It ends badly, but people like to play the price movement. And sooner or later, the casino always wins. So if you're betting things on price movement versus underlying fundamentals, you're going to give it all back to the casino. If you don't do it on this one, you'll do it on the next one, and Allbirds is no different.
Brooke, I was scrolling around. They started a day with us. I, of course, am biased, but I know they do. And they're seeing S&P 500 over 7,000. Why not S&P 8,000 by year end? I mean, if the economy is going to hit, if the market is going to hit over 7,000, while we have $4 a gallon gas, we have inflationary pressures picking up. The economy has slowed down based on various indicators like the ISM last week. If it's going to do that right now, what would prevent it from going to 8,000 by year end?
It's not out of the question, but I wouldn't bet the ranch on it there, Brian. Look, markets climb a wall of worry. And, we all know in the short term, the market is a voting machine based on emotions and headlines. We saw that 10% drawdown in the S&P on that short term basis. But in the intermediate to long term, it's a weighing machine based on fundamentals. And the fundamentals are good. Earnings estimates continue to go up. $322 for this year for the S&P. I think we started the year, $10 lower. $374 for next year. We started around $365. What the market sees is this is a short-term blip. It's very much like the tariffs. It was started with a tweet. It ended with a tweet. And I do have to say, politics aside, the blockade was the equivalent of checkmate. At the end of the day, if Iran has no money, they're going to do what we say. And, I think it's just brilliant. They tried to take over the strait, which doesn't belong to them. Then they were extorting the world, $2 million a ship. And Trump said, wait a second, you have no right over it. We've got a bigger military. Now the strait belongs to us. Now you want to come down to the table? And that's exactly what's happened. And the market has figured that out. It's also what happens, Brian, when you see hedge funds record short in the hole, shorter than they were in the 2022 lows, shorter than they were in the COVID lows when we had no idea if we were going to get a vaccine.
Tom, this is just short covering then. I mean, is this really belief in fundamentals, though?
Of course I believe in the fundamentals. I just talked about earnings. I mean, the earnings growth is there, Brian. But I will say that you're going to see, and we've seen, a rip your face off rally. And we've come on your show in the last few weeks, buying on red days, getting punched in the gut every day, keeping to buy on red days because the underlying fundamentals are strong. I do think we are in an election year. I do think after we get up a little bit further and everyone starts to believe this and we get everyone back in the ship who sold in the hole, all the CTAs, all the hedge fund, all the retail that we're selling down, now buying up, I do think we're going to get a little bit of weakness in the back half of the year into the election uncertainty. That would be normal this side of the year. But in the meantime, while the music's playing, you got to get up and dance. And if you weren't buying when it was down, guess what people are doing now? You had record puts in the hole, people buying insurance after the house was on fire. Now you've got record call buying, people trying to catch up. And these Johnny-come-latelys, I don't know whether it's going to be 7,200, 7,300. The Johnny-come-latelys are going to get taken out to the woodshed and probably not be happy chasing it very, very late. And that's probably a few weeks from now. First, you got to get the software catch-up trade. I think you're going to get a bid in software. That bid, by the way, I'm telling you right now, Brian, you'll have me on in 3-4 weeks. Everyone is going to be crazy excited about software again in 4 weeks from now. And that rally will be sold. Why will it be sold? Because institutions got trapped. They didn't see the trap door early this year when everyone was chasing the shiny objects, companies trading at 100 times sales, 100 times free cash flow. They got completely obliterated, most of them down 50%, down 30%. You'll get this reflex rally. It's going to rip up. Everyone's going to chase them at high. And the trapdoor institutions will use that strength to finally get out, the ones that got trapped. And I think you're going to see some further weakness into the fall. But in the meantime, we're having fun. We're buying good, boring businesses like we always do at great prices, and we're enjoying the ride.
Brooke, how are you spending your Reese Witherspoon fan? I mean, if she's coming out here bullish on AI, I mean, you got to ride this NVIDIA rally, right?
Legally blonde, absolutely. Listen, and it's a law of large numbers. You got a $5 trillion market cap. What do we have? GDP about 30 trillion. So, give or take 20% of GDP. It's trading at 50 times free cash flow. There's no question demand is going up. But while everyone's been focused on NVIDIA, which has done nothing for 9 months, Intel's up 200%. And we couldn't give it away when it was at $19. No one wanted the stock. We made a big bet on that, up 200%. It's going to $100. You want to bet on Lip-Bu-Tan? He had a 68 bagger at Cadence Design Systems, and that's where the growth is. As far as NVIDIA, their business model relies on the kindness of strangers, and that's Taiwan Semiconductor's capacity to deliver against that demand. Last quarter was a step in the right direction. If you remember, they had been capped at about $4 billion of revenue growth per quarter. NVIDIA had been because of the supply chain bottleneck with Taiwan Semiconductor. That seemed to open up a little bit. The question question is how much of that is priced in. I think on this reflex rally, you are going to get a little bit more running room on tech, because tech was beaten down so badly. So you want to watch the 212 level. If NVIDIA can break through that, maybe it's got a little bit more run for the next few weeks.
All right, let's keep moving here. Snap just booted 16% of its workforce as it continues to try to be a profitable public company, which has proven elusive. Literally, the AI-driven mega layoff. Amazing news for investors.
Still at 4.3% unemployment rate. So I think there is going to be some friction around job relocation, but you've got the build out that's going to require a lot of skilled labor. I think there will be some short-term friction, but as it relates to Snap laying off people, no love lost for Snap. Okay, these are guys that have been paying themselves massive stock-based compensation. They've increased the share count from 1.2 billion to 1.7 billion, continue to pay themselves instead of paying partners. And the stock's been in the gutter ever since. People got wise to it after the bump in 2021. So, now they're taking drastic actions. I'll tell you what, why don't you give up all your stock options, give some money back to your partners, and maybe you'll attract some investors that trust you. How's that for starters? And then you can worry about getting costs in line, rebuilding your advertising business, and hopefully you still have kids doing those contests that keep them on your app.
There you go. Snazzy hot take from Tom. And I should mention, I got to get my good insight, you all. Tom, Brooke, and Inez, really appreciate it. I'll talk to you guys.
And we're back. And with that one, that was the full half hour. So again, Zach cut out those items. Also want to thank Niket, Nishant, and Chuck Mikolajek for including me in their article on Reuters this week. You can find it at hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Consult your financial advisor, psychic, and or other trusted advisor before taking any action. If you don't have an advisor, well, there's a guy. I know a guy. Anyway, I got a guy. Benjamin Graham, in the short run, the market is a voting machine, and we like to say based on emotions. But in the long run, it is a weighing machine, and we like to add based on fundamentals. That is the core theme of what we do here at Hedge Fund Tips with Tom Hayes. And more importantly, what we do at Great Hill Capital. In the world of business, the people who are the most successful are the ones doing what they love. In case you haven't noticed, I've been doing this for 340 weeks, not as a task. I don't need the money. I do it because I enjoy it. I love the game. I love competing. I love delivering value. And we'll be doing that for a very long time, just like the master himself, Buffett, who went 95 plus and he's still going. So love that. Got this awesome picture from the boys over in England. This is Patty and Pals. I've met these guys and they played Royal Troon. I had to include this. They've all got their Hedge Fund Tips hats on. And because of those incredible hats, their combined score on Royal Troon, by the way, this is a no joke course, was -3. They were -3 between the four of them. These are some sticks we got here that still make time to listen to Hedge Fund Tips with Tom Hayes. Share the word with their incredible Hedge Fund Tips hats, which reminds me, by the way, I've been getting a lot of people sitting me down like, hey, Tom, why do you keep this open for everyone? Just close it down and do it for clients only, set up a paywall, blah, 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 blah. Look, I think those are all good advice, but you guys are doing your job, which is sharing the good news, and we are growing. And if you keep doing that, I'm going to keep providing it free of value, not only to keep my clients updated on our portfolio, which has been priority number one, and be able to talk to them all at once, and then see the special expressions in their portfolio and the options overlay that deliver excess alpha, but to give value to everyone. The ones that can't afford, keep them out of the all the shiny object stuff that just blows people up. A simple common sense framework like Warren Buffett gave to me and so many millions of others and changed so many people's lives. So if I can give a fraction of that value to people over time and or a lot more. That's what I'd like to do. And all we ask every week in return is that you share it with one person you care about that would benefit from this material. And a lot of you, because you're, don't want to talk to people directly, you wear the incredible merch, which you can get at hedgefundtips.com. You just scroll over here, click on the hat. The website will come up. People will ask you, what's that all about? And you can just tell them, and then send in your pictures to info@hedgefundtips.com so we can get you posted with all these other incredible people wearing their golf shirts, their hats, and everything else. All right, moving on. Let's start with the technicals this week. We've got some Slumer stuff from my buddies over at RBC. You can see here S&P has bounced back, looking like a little resistance around 7,300. We got a little ways to go to get there. We've got the US dollar index started to roll back over after the counter trend move as we had anticipated. Looks like another bounce in the downtrend. You've got the 30-year yield has been pretty contained through all this Iran noise. Tech is back up against, ready to break out again. I think that's going to be what leads us to 7,300. We're seeing it in Intel now, over $80 a share after hours. 4-bagger, ladies and gentlemen. 4 baggity bags in 2+ years. We like that action. How you doing? All right. Next, technology back up. Yields we covered, and on to the pod charts. This we've talked about. You could see institutional options. They couldn't get enough puts. Now they can't get enough calls, so they're playing catch up. Their CTAs have maxed out. So we probably get a little breathing room here in coming days. Maybe Trump does something wild over the weekend. Who knows? But that's that. China tech stocks on verge of breaking out. Hallelujah. This was so exciting for us to be able to put new clients this quarter into BABA, which got down to the high 100, like I think it got down to 118 and 120s. And we're like, this is so exciting. So we're glad to pick up some shares there. Now it started to move up again. Here is consumer discretionary versus the S&P 500. We've been talking about this on a lot of the media stuff. You want to take advantage of opportunities. VF Corp is running away. It's back over 20. Maybe it took a little breather today, but we like that. And then active equity funds ownership of energy is low versus history. We think there are going to be more opportunities to buy energy, like Comstock, like National Oil Well, but National Oil Wells run a lot. So is Comstock off our basis. So we'll wait for better opportunities to get there and stick with those for a while. Next is, let's see, value has outperformed the most since 2000 in the March quarter. Amen. Hallelujah. We love that. Consecutive months manufacturing has expanded. Looks like we're getting the best manufacturing growth since going back to the 70s, 80s, and 90s, and just now exceeding the 2013 to 2014 bump in manufacturing. Industrials did well during that period. What else we got here? Single stocks, daily flows. Retail investors didn't buy this dip. They kind of missed this rebound, which was disappointing to see because they'd been pretty good post-COVID. And I think what happened is they got too over-levered and they got blasted out at the exact wrong time. And a lot of the financial advisors, I talk to very successful entrepreneurs all the time. I'm in some peer groups, and a lot of these financial advisors sold these guys down in the hole a couple of weeks ago. And it's very, very sad to see. Bad for them, good for us. They're now sending more money our way because we were buyers, not sellers. On to the next, chasing S&P options. They all missed this rebound, so now they've got to buy with leverage, which means we should get a 3 to 5% pullback to hurt the Johnny-come-latelys. It's the way it always happens, and so on. Semis have had obviously a monster run. They're probably due for some consolidation. What else do we have here? Returns after tax. We've covered that. Forward earnings expectations still rising, retail sales still rising, consumer sentiment still in the toilet. You buy that, not sell it. Last time it got this low was the bottom in 2022, and the COVID lows before that, and the great financial crisis lows before that. What else do we have here? Earnings growth peaks 3 to 6 years after the first Fed rate cut on average. And we had the first cut in 2024, it looks like 19 months ago. So on average, it's looks like 40 to 50 months here. So we've got a long ways to go. Fed, S&P shifted from asset heavy to asset light. We know that. More clues, the lows are in. This is from Ryan Dietrich. Back-to-back 3% weekly gains, 6 months out, up 9.8%. China online retail sales up 8% year on year in March. That really helps BABA. They are the toll taker. Thanks to Brendan Ahern for putting that out. Retail has lost patience with policy volatility. They sold leveraged ETFs at the highest pace in history in the hole a couple weeks ago. Housing market index, seasonally adjusted, starting to turn up a little bit. Wall Street's year-end price targets are all above. These will have to go up for some of them. What's up with healthcare? Healthcare relative to industrials. Healthcare is going to absolutely rip. We've covered healthcare versus the S&P. Someone asked me anything question. The market's going up. Why didn't Baxter go up? Baxter's a special situation. And why we can do so well on a relative basis to the indices is because our correlation to the indices is very, very low. When our positions turn, like you've seen with Intel had like zero correlation with the S&P for 2 years. When they turn all at once. So you wind up getting, a decade worth of gains inside of 12 months once they turn. So if you're looking for stocks that go up when the market goes up, you're basically wanting to closet index, in which case you might as well just buy the S&P for 2 basis points and get the index without the drag. But if you want excess returns, you should have very low correlation, and you should be underwriting each security as if you were buying the entire business with 100% of your net worth, which we've covered 1 million times on the podcast. Put call ratio activity, you could see that we were record put buying in the hole. Cash levels for retail was near a record. Put options for retail near a record early April. Small biz CapEx plans slumped to lowest since great financial crisis. That's kind of interesting. I think that's going to change with Warsh coming in the next couple of months. Tax refunds were $36 billion, up about 15%. And by the way, gas prices is such a smaller percentage of the U.S. household spend than it was 10 years ago. It's become such a de minimis. It's not that it doesn't hurt. And by the way, if energy prices stay elevated, that's going to have an impact on company margins because it relates to the input costs of a lot of goods. So we're not taking that with a grain of salt. We're taking that very, very seriously and watching it. But that's that. I also covered this 10-day rally is historically bullish. That's from Dietrich, 6 months out, up 11%. This is 3% weekly gains 3 weeks in a row. It's only happened 2 other times. 6 months later, the market was up on average 20% those 2 times, but that is too small of a sample size. Retail sales were good even when you back out gas. Path of bottom-up EPS estimates since 1985. Normally, by this time in the year, estimates would be rolling over, and this time they're not. They're actually still going up. They start off hot in the beginning of the year, then analysts bring them down after Q1 and Q2 earnings. So far, they're not bringing them down. They're going up. Earnings estimates soar. Full year 2026 is expected to now be up 18%. Just a couple months ago, up 14% was the expectation. Truckload demand diffusion indicator. Truckloads are going up. What does that help? It helps overall commerce. This is like watching rail traffic, and it's kind of a leading indicator for the economy. Should also be a leading indicator for GXO. Speaking about GXO, what a great week for Brad Jacobs on the QXO deal, making a dent on that $50 billion revenue goal, $7.5 billion of EBITDA. And we got that truckload, CTA positioning. We got Cox Automotive Affordability Index. This is key for the CPS thesis. Didn't get a chance to cover it on Charles Payne. We ran out of time, but we covered it on one of the other shows. This is a key catalyst, I think, with Diane. So check that out. That bodes well. Next thing we need to see is incentives rip higher. You got the deductibility of auto loans on U.S. cars and the average car on the road at 14 and a half years. So this is going to boom. Cooper effing standard, baby. All right. Weekly change in equity positions. So the chase is on. This is around major geopolitical events. This is key. This kind of shows the path that we followed this year, which is consistent with past geopolitical events over the past 50 years. And, you get this straight up V, and then you continue to press higher because it lets no one in, just like you saw during the COVID lows. Early stages of a productivity boom. Last time we saw anything like this was PC adoption in the 80s, internet adoption in the 90s. This is a big deal with AI adoption, and I'm sure all of you are seeing it in your lives, whether you're using Gemini or ChatGPT or Claude, etc. It just enables you to do more of the same thing with less time, more productively, but you have to know the framework and the right questions to ask it, or garbage in, garbage out. 3 times in the last 76 years that the S&P has posted 3 straight up weeks, and you can see what happened 6 months later. Next, S&P broadening supported by profits. Friend texted me today. He's like, 100,000 to the grandkids. What are 3 stocks? And I was like, well, here are the 3 stocks if you're going to get them out when I get you out, in which case, you have to manage that. Otherwise, just buy 3 ETFs. I'd get, right now, I'd be inclined to be small caps ETF, emerging markets ETF, and all market US ETF, and just let it run. If you want to set it and forget it, I think that's where you're going to, I'd probably go small cap value, emerging markets, and equal weight US, and let it run. All right, this is just showing the dollar is overvalued. We've covered that. Retail participation was much lower versus Liberation Day. We expect more to come. They have to chase up. There are over 40% more home sellers than buyers, 43% more. This is going to cause lower prices and greater affordability. Caitlin keeps sending me all these houses that are selling in the neighborhood where we just bought. Because I told her, I was like, we got a great deal on this, blah, blah, blah. We'll put some money in, made it beautiful. But just so you know, we're buying the top of the market, and she's like, no, this stuff, I'm telling it doesn't matter. It's not an investment. It's a liability. Anything that you put money into that has ongoing costs is effectively a liability. Maybe it's going to go down before it goes up. That's effectively what I told her, but we're going to own it for a long time, so it doesn't matter. Anyway, the point is, if you're waiting to buy a house, things are going to get better and better. And you think it's not because Washington's going to lower rates. I'm telling you, that's when supply is going to flood the market, and no one is expecting it, and you will see. All right, institutional client, maybe we're a little insulated in the little pocket that we're in, but nationwide, I think it's a very fair and accurate statement. And that's going to bring a lot of real estate investment funds back into the stock market because they're going to get nervous about having all their money tied up in real estate. Institutional clients were the biggest net sellers last week at the exact wrong time. If it's the earnings, stupid, keep going up. Bottom up consensus keeps going up. This is an interesting thing from Bespoke. It shows the presidential pattern of Trump in since the first and second inaugurations, which implies, we went through this chop that you did the same time in his first term, and then you just grinding higher. I could see this kind of little volatility into the election and keep grinding higher. We'll see what happens. That's not a good enough sample set, but it's interesting to observe. All right, some news. JP Morgan says China property tipping point will drive up stocks. U.S. investors pour into Hong Kong, China equities with largest quarterly inflow in 3 years. Opinion follows trend. China's DeepSeek looks to tap external investors, including Alibaba and Tencent. Alibaba has a piece of every AI startup in China. They all need compute. They say, no problem. Like a good drug dealer, we'll give you a free sample. We give you free compute. You give us free equity. And that's what's not modeled into anyone's assessment of Alibaba's valuation. Alibaba moves on to Tencent's turf with AI model for 3D video. China's GDP stronger than expected, led by infrastructure spending. Intel lands Tesla as first major customer for the 14A chip technology. It's all coming together. Intel shares soared to highest since 2000 on turnaround optimism. It may, in fact, I think, did just take out those all-time highs. Intel hires Samsung executive Han in push for foundry customers. Han was at Samsung. He brought all the customers to Samsung, which is the second biggest fab. Now Intel's got the salesman from there. He's going to steal all the clients. We love it. TSMC warns of Intel's foundry growing prowess during the company's latest earnings call. Quote, "We view Intel as our formidable competitor and do not underestimate them." Absolutely. When you have the president and commander-in-chief not only selling Boeing aircraft, but selling Intel chips all day long. Morgan Stanley sees agentic AI widening chip spending beyond graphics processors to CPUs. We covered that. Boeing CEO says all systems are go to increase 737 production as company narrows losses. Boeing CEO, Trump is key to closing major plane order from Chinese airlines. They're looking to get 500. Stock will probably blast up on that, and we'll see how things look then. Trump's $1.5 trillion defense budget includes $750 billion for ships, jets, and Golden Dome. QXO to buy insulation company, top billed for $17 billion. We covered that with Charles Payne, and they're cooking on all cylinders. So people are like, well, yeah, someone asked in an AMA, and I do look at some of them before the call, but usually not. How's it not dilutive? Well, it's not dilutive because he's raising capital at 20 times EBITDA and he's buying the business at 15 times EBITDA. And I can tell you when, not if, but when at some point in the future, QXO trades at 8 times EBITDA, Brad Jacobs will do the other side of the trade, which is buy in shares till the cows come home. He did it at XBO. He did it at United Rentals. So he sells stock when the multiple is extremely high to use that to buy businesses at a lower multiple. And then once the multiple goes low, he uses the cash flow from those businesses to buy in the stock and increase our ownership back up in the business. So he's brilliant. No one else does it like Brad Jacobs. America is the middle of a stealth manufacturing boom. We covered that on some of the Fox shows. 5 reasons an oil capex upcycle is coming and could echo 2000's boom. It's been our case for the last year. We've been telling you when you couldn't give away energy last year, National Oil, well, Varco is the best way to play that. Big oil plows billions and Comstock Resources into FART, which we covered on Bottom Line with Brian and Lydia. Far-flung drilling sites to escape Iran turmoil. Texas electricity demand could quadruple due to soaring data center demand. Guess who's going to provide that in East Texas is Comstock Resources, ladies and gentlemen. 1 billion cubic feet of gas per day, all day long. U.S. natural gas exports grow nearly 30% by 2027 as LNG facilities ramp up, baby. Big tech's giant headache. Billions in AI capital spending and investors demanding quick results. That'll be a problem in the fall. I think the hyperscalers will get hit again because 1 or 2 of them are going to blink and they're going to say, we're going to pull back on it. Everyone will say the AI trade's over and that'll be your last chance to buy it mid-game. It's not 7th inning stretch. It's more like 4th or 5th inning stretch. AI boom poised to be massively disinflationary. Northern Trust says. Warsh is betting on the same. We agree. Trump administration takes steps to refund $166 billion in tariffs. It got voted out. He'll have new tariffs, but in the meantime, companies like Cooper, like VF Corp, they're all going to get money back. Retail sales surged by the most in a year as spending extends beyond gas. On no one's bingo card given the war, but the consumer is strong when they have a job. And right now at 4.3% unemployment, they have jobs. Pizza chains, Papa John's and Pizza Hut edge closer to finding new owners. Sources say, I don't think they're going to trade Papa John's at anything below 60, and I don't know that they're going to get 60. I think they're going to run it. I think Penniger wants to get a double or triple and make money like he did at Wendy's, and I think it would be foolish to sell it at anything below 75. And even then, we're getting some of the upside robbed from us, but we're getting it quickly, so the IRR is satisfactory, and we would accept that. But 47, get the hell out of here. Pound sand. Estee Lauder seeking $5 billion for Puig deal. Report says. We'll see how that goes. I think they've been buying and selling brands for 100+ years, or like VF Corp. They're gonna not 100, like 75. They'll figure it out. All these analysts who think they know how to do it better. They don't. Disney debuts giant screen brand for cinemas to rival IMAX. Great. We got that business for free. The end experiences business is worth, $80 a share on a standalone basis. The sports, the TV and the films are free. And the streaming, by the way, which is now cash flow positive. So, happy to hear that. Had my friend Andrew on the podcast some time back talking about his Ethereum trust, ETHM. It was called Dynamics at the time. I participated in it because he's a good friend. They are not going to do that merger with the SPAC with Dynamics. They mutually agreed to terminate the deal. They described it because of unfavorable market conditions and timing. And we appreciate that. That's the right thing to do. Most people would just try to push it through so they could benefit, but they looked at it and they said, we're not going to do it. They're returning all of the capital. And if anyone bought shares in the public company, I think it's gone up on that news. So you've been able to sell out at a small profit. And that's that. Whatever they do next, I'll also want to be involved because they're winners. End of the story. Okay, past the turbulence, stock market and sentiment results. Let's see. We got all the media here. We're going to cover Boeing real quick. For new readers, the brief overview and key drivers behind our Boeing thesis. Obviously, it's up a lot since we got in. No one wanted it last year in the 130s. Everyone wants it up here in the 220s. They're going to want it even more above 300, and we might be inclined to help them out. But the story's getting better, turning free cash flow positive, hitting on all cylinders, and the game hasn't begun. I mean, maybe we'll be inclined to hold it for a lot longer, but let's go through the first part of the story. Boeing kicked off our Q1 earnings season on the right foot with every metric that matters in this multi-year recovery moving in the right direction, starting with the headline numbers. Revenue of $22.2 billion, up 14% year on year, beat consensus by $290 million, and the adjusted loss of 20 cents per share came in far better than the 76 that Wall Street was looking for. And free cash flow burn of just 1.45 billion was nearly half of the 2.6 billion consensus had penciled in. Clean beats across the board. Commercial deliveries once again did the heavy lifting. Boeing handed over 143 airplanes in the quarter, the most of any first quarter since 2019, and outshipped European rival Airbus by 29 jets. Amen, hallelujah. The French are sleeping at the wheel. That's the widest delivery gap over Airbus going back to 2018, a stat that would have sounded like fiction 12 months ago when being constructive on Boeing got you looked at like you had three heads. Now that the stock has climbed nearly 70% since Liberation Day lows, investors have suddenly rediscovered the global aerospace leader and are excited again. Welcome aboard, albeit at prices where we're already well on our way to a double. One of the big reasons we got comfortable making the original investment, besides Boeing being a national champion and global duopoly, was the long and forgiving runway of a $500 billion backlog. That backlog continues to set new records, reaching almost 700 billion with over 6,100 commercial airplanes, more than a decade of production runway at the current pace. Boeing's troubles never stemmed from a demand problem. Demand has consistently outstripped supply, with airlines clamoring for every plane they can get their hands on. All Boeing had to do was safely build them, something they're finally starting to do. Which brings us to the heart of the thesis: free cash flow. Deliver more planes, generate more cash. 6 words that capture the entire turnaround. Q1 showed continued progress on that front, with 1.45 billion burn. Normal seasonality coming in far better than feared, with management reiterating the $1 to $3 billion positive free cash flow target for the full year. The first positive year since 2023. And while it's great to see free cash flow finally flip positive, the recovery is still very early innings as production ramps and one-time headwinds roll off. The long-awaited $10 billion annual figure should have the green light by 2028, a figure that increasingly looks like a pit stop than the final destination. Beyond the numbers, the setup for the back half looks clean and catalyst-rich as anything we've seen in years. We're finally closing in on the long-awaited Trump-Xi summit set for May 14th to the 15th. The key driver behind Boeing reportedly closing on one of the largest orders in history, 500 737 MAX jets, along with discussions for another 100 wide-body aircraft, including 787s and 777Xs. As we've discussed before, Boeing order has increasingly become as we've said before, a Boeing order has increasingly become the price of admission in the U.S. trade negotiations. With the world's greatest salesman setting up shop in Beijing for a few weeks, we'd be surprised if he came home empty-handed. Boeing CEO Trump is key to closing major plane order from Chinese airlines. On top of that, Boeing is benefiting from tailwinds across the booming defense business, with revenue climbing 21% in the quarter to $7.6 billion, and a newly signed 7-year framework agreement to triple PAC-3 seeker production, with a proposed $1.5 trillion fiscal year defense budget, the largest year-over-year increase in defense spending in the post-World War II era. No let-up looks to be in sight. All of which is to say, this quarter marked another meaningful step forward for the global aerospace leader, and investors are finally starting to take notice. The national champion and proxy for U.S. manufacturing that you couldn't give away in the 130s last year is now doing exactly what we expected, delivering more planes, generating more cash, and reminding everyone why duopolies with decade-long backlogs tend to work out just fine for investors who can stomach a little short-term noise. There's still plenty of work to be done, but with Kelly Ortberg in the pilot seat and the factory floor safely humming again, our confidence in the turnaround has never been higher. From here, it's all about execution, and there's no one we'd rather have in charge than Kelly Ortberg. Clear skies ahead. So here is the Q1 earnings breakdown. We've underlined, highlighted, circled, and starred all of the most important points that you can check out at hedgefundtips.com. And here are the 10 key points you can read at our article of the week, which you can find all of our articles when you go to hedgefundtips.com. Click on commentary. They're all there. Or usually if you just go to popular posts, the article of the week is in that top 5 and working higher on that day. On to the second company we're going to cover this week, which is Crown Castle update for newer readers. Here's the brief overview of the key drivers behind our Crown Castle thesis. Pure play U.S. tower REIT and high yield income name that becomes increasingly hard to ignore as rates come down and capital rotates back into yield. So we've covered and highlighted all the important things with the 10 key points. You could also find on hedgefundtips.com. There are no key changes in thesis on that one. That's just a waiting game, and we covered that just a few weeks ago. So read that over at hedgefundtips.com. Got to get through a lot of AMAs, and we had a tremendous amount of media. Fear and greed is not yet extreme. It's at 68 out of 100, usually over 80 is where it starts to get frothy. National Association of Active Investment Managers just barely catching up. They're only at 80%. You want to start to worry when they're at 100%. So they've got to catch up. And that's that. Yeah, we closed out the Q2 raise about 13 days ago. Congratulations to all of you who took advantage of it. And the larger $5 and $10 million accounts plus can come in any time. I also had a suggestion that we go back to only allowing $5 million plus accounts. It's under consideration, but not imminent. Basic materials, top 30 weights, estimates went up 4.13% in the last 60 days for 26 and up 2.4% in the last 60 days for 2027. So where are the big jumps? Freeport Mac got a pretty big jump. Nucor got a pretty big jump. That's modest. Dow Chemical, big jump. Albemarle, of course. For those of you who know, we got into Albemarle at 59. It shot up faster than we could have ever imagined. Sold out at 164. It keeps going higher. If you can't take a joke, well, let's. I never like to look at it, but all right, let's look at it. How bad? How bad does it hurt, ladies and gentlemen? No, look, when you get a triple bagger in less than a year, yeah, it hurts a little. 193. All right, on to the next. And looks like LyondellBasell. So these chemical companies are coming out of the woods. IBT 50 growth index top 30 weights in the last 60 days. Estimates are up 16.4% for this year and 30% for next year. What are the biggest drivers of that? Looks like Stericycle. I'm not sure what that is. These are a lot of new name companies. Micron, this is that peak earnings story. We'll deal with that. Taiwan Semi. Okay. Economic data. Retail sales were the big story this week, coming in better than expected. And what did we get this morning? Initial jobless claims a little higher than expected. Continuing claims a little bit higher than expected. Services PMI in expansion, better than expected. Manufacturing PMI was the big deal. Way better than expected. 54 versus 52.5, 52.3 previous. And tomorrow we're going to see Michigan consumer sentiment. Let's see how that turns out. And rig count, which we'll pay attention to for Varco. Earnings estimates. Earnings results came in 13.2% for Q1, which is much higher than expected. Let's take a look if estimates went up again this week. Yeah, just a tad. 375 for next year, 323 for this year. Great. Well, let's get on to the Ask Me Anything questions from our incredible viewers. If you have a question for the podcast, you just go to hedgefundtips.com, click on contact, and you enter your AMA right there. Click where it says, put in your name, email, click where it says AMA question for podcast VideoCast, write it in there, and boom, we'll get it, and we'll cover it right on this show. By the way, want to say, first and foremost, none of this would be possible without the underwriting of our incredible clients at Great Hill Capital. So if you are one, thank you very much for your support. If you are not one and you know one, call them up and thank them tonight for making it possible for us to do this incredible podcast, and then go out and share the podcast with one person you care about. And I can't tell you, it's amazing the number of accounts that came in Q1 who basically transferred in all of our positions because they made the money to invest with us from listening to the podcast, which is just mind-boggling. And that's why I love that $1 million level, because it makes such a high value service available, even if people don't have it. If they do the work, capital plus labor equals output. The rich people are smart. They just put their money in and let Tom make the money for them. But the people that don't have it, they have to put in the time and the money. So they have to listen to the podcast every week, kind of follow along and invest over years. And then eventually they get the money. And then they're just like, I want you to do it. And I want to get the overlays, and I want to get the alpha and all that stuff. And, we're very, very, very grateful all around, and to all of our listeners. So, all right, let's rock and roll. Question number 1 comes from Sam R. Comstock looks to be a good entry again. Do you agree? Yeah, I mean, we're up double from the basis, but yeah, I would buy some here. Why not? Marcel Bala. Stabilis. Okay. Stabilis. Stabilus. Let me just write these down. Okay. That's a different Stabilus. Okay. Stabilus. It's a German company. $56, so it's down 2/3. Revenues are a little flattish. Debt's a little high. Shares outstanding coming down. What do these guys do? Gas springs, dampers, electromechanical damper opening systems, vibration isolation systems, industrial components used in automotive, commercial vehicles, railways, construction. I kind of like this. Have to do a lot more work on it, but I think generally, let's just take a look at some of the basic financials. 195 million, 183 of receivable, $800 million debt. So first thing you want to do is find out. So they got 100 million of current. What's the free cash flow doing? Key is the balance sheet here. That's why it's trading where it is, but I think it's going to be okay. Free cash flow is growing. I kind of like this one, Marcel. Let's, what's the ticker here? STM.DE. So worth doing more work for sure. I think they've been buying in stock. Revenues are slowing but growing modestly. Low multiple. Yeah. Share count stable. Stock-based comp reasonable. I like this. I would just try to understand what are the growth drivers moving forward, and do they continue to have a moat in their area of business? That requires some work, but I think from a financial standpoint, you got one that looks okay here. So that was Patty Knappman from the Royal Troon, 3 under par. That's pretty damn impressive, gentlemen. Good work. Eric Camus. Thanks for all the amazing educational content. What do you think of Lulu? Lulu, we've continued to look at and avoid. They just hired a woman from Nike, which Nike hasn't been doing well. I don't know. I mean, Aloe, see, the reason I like VF Corp so much better than Nike and Aloe is it's like I can be wrong a lot of ways and still make money. And they had enough optionality to sell things out. I mean, Nike, sure, they could sell Converse, but who's the buyer? And it's not even going to move the needle. Same thing with Lulu. They can't sell Lulu. They are Lulu. So I like having, when you're dealing with consumer brands or things that are subject to fads and cycles, I like having options and outs. Like if you look at all these food companies, they have 100 different brands they can buy and sell until the cycle turns. So with this one, I do agree that it's getting cheap. I don't know that they made the right pick for CEO, to be honest with you. So I'd have to study it further. They're buying in stock. At some point, you have to take a punt. I just can't tell you if they made the right pick or not on the CEO. I got to investigate the jockey more. But on a business basis, just looking at the financials, I've been interested for a while. I continue to be interested. I just don't know if they made the right pick for the CEO. So let's leave it at that. And that's why we're not really interested in doing a whole lot. So this was Jason Matthew asked about Baxter, and that's what we explained about a special situation. When they turn, it's like it's binary, and once they get that first quarter, then you get 20% move, and then the analysts start to upgrade it, then the institutions start to buy it, then it starts to go up, then you get more analysts upgrade it, and it just changes overnight. So like, you know, while the market may go up 8% and it goes down 2% during that period, when it turns, it's up like 70%. And that's the way the special situations work. Buffett used to call them the workouts. If you read his his letters from his partnership days when he had his best performance of his career. Thoughts on Badger Meter from Barry Lisard, BMI. Whew. Manufacturers, flow measurement, quality control, communication solution, utility water, smart metering, municipal water market, flow instrumentation, valves, blah, blah, blah. $19.05. I wish it was down more, but I don't know if you're ever going to get it to come down more because it's a good quality business. I like it a lot. I would like it more at 100. Really good work, Barry. Next. And by the way, when I endorse it, it's not like I'm going to go invest in it tomorrow. It's like it meets all the criteria of something I would want to do more work on and possibly invest in. You still have to understand whether the moat is temporarily impaired or permanently impaired. Stocks don't go down for 50% for no reason, but it checks all the boxes. I think there's a lot of ways to win on this one. Chris C. Enphase Solar. You know, we got this name every week forever, and we kept saying no, and it's gone a lot lower. I hate that business, but it might be at a level where it's interesting. Share count stable. Yeah, let's see here. This one's frustrating because I do think that it's probably time to get involved with this one, but I don't like this business, so it's probably a pass for us, but I think it's going to go up over the next few years. Yeah, I'd like to get some color. I would listen to the management calls about getting some color on how they're going to turn around free cash flow. But I do think that this is getting very interesting. Stock-based comp is a little bit out of control, but they've kept the share count down. By buying back the stock to the management. I don't like that, but yeah, I think it's worth doing some work on. Good job, Chris. Lachlan Neo. Thank you for generously in sharing your wisdom and sharing your podcast with friends and family as always. Thank you very much. Want to ask your thoughts on British company Reckitt. Seems to have great brands. Okay, RECKITT. It's not down enough for me, and I think it's too early. KT. Yeah, for us to get interested in anything, it has to be at least a double or triple over a few years. This does not have that potential. It just seems like it's been flatlining for a while. So for that reason, I'm pass. I don't think you get hurt on it, but I just think they're better, higher and better uses. Celsius Holdings. I do like their product from time to time. Yeah, I forget what they made some mistakes, and there's some controversy around the product. That's and they made that acquisition. Share count continues to grow. I would get more interested below 25, but let's see. It's just such a crowded field. Like everyone keeps comparing it to Monster and Red Bull, but when they were growing, it was all that was out there. Now it's like 2 cases full, and they've got three flavors that are good. The rest are crap. I think I like the watermelon, the grape, and the mixed berry. The rest is like guava. Ugh. All right, so let's see. Balance sheet's probably good. Yep, cash flow. Yeah. Income statement. The issue is it was growing super fast. Now it's not growing quite as fast, and people are getting concerned. But let's see here. Share count. Just keep adding shares. Who are they giving them to? Yeah. I mean, you got a 20 times multiple on what kind of expectations? $20.27. Okay, so let's just see something here. 2027. Yeah, this is kind of your issue. Got 20% growth coming into this year. And then next year, 20%, and then it slows down 28. I think, let me just see here. It's just flatlined for like 4 years because a lot of it got priced in ahead of time. So you're consolidating, you were paying for what is happening now years ago, and then the growth rate slowing at the same time. I mean, you could probably squeeze a double out of this over the next few years, but you got to watch it like a hawk. Tim D, I think it's okay. CELH. So Tim D asked about FICO, software stock. Talk to me if it gets down to 600. I don't know that it ever will. But with these software stocks, same with ServiceNow, you want to buy them, but it's just going to take a while. This thing, revenues are flat. Taking the share count in. I think you'd be okay with FICO, but I think you'd be better off buying it at 600 if you get a chance. So for now, I'm a pass. That doesn't mean it won't go up. I like your thinking behind this, Tim, but I just wouldn't pull the trigger here. Matt in North Carolina asked about the top build, diluting the stock. Yeah, we covered this. It's not dilutive, it's accretive if you're raising capital at 20 times and buying businesses at 15 times. So hope that's helpful. Rock Russell, Intuitive Surgical. This one, I think they have a little bit of breach of the moat, kind of like Align Tech in the dental business. Yeah, this one hasn't come down enough. Like, resend it in if we get like 350 on this, but for now, it's a pass. Doesn't mean it won't go up, but we can't get a double or triple on that. Watch your broadcast. I mentioned uranium. Okay, so this is from Michael Costa. I was talking about uranium on the show. I wouldn't bet on any of that. I'd bet on natural gas. Uranium is going to be too far out. And you're overthinking things, Michael. Stick to productive assets versus betting on prices of things. Jackson Hauk, so grateful for everything. CLSK, energy data center with the bit miner part is gravy. Thanks for teaching me enough to become a client. Yes, very grateful to have you as a client. CLSK, this is a data center play. Jackson has been with us many years and made money off the ideas for many years before becoming a client, and we're very grateful for that. A lot of negative free cash flow there. This is a speculative play. They're diluting you on this, Jackson. I would pass on this. There are better ways to play, ancillary ways to play it. Play data center build out, Stanley Black & Decker, all the tools that are going to needed, Generac, all the backup generators, a $1 billion backlog. Intel, all the Xeon chips, the data center chips, much better ways to play that than the actual play, or even BlackRock. I don't know if those guys have come down or not. BL or BlackRock, Blackstone. No, they're not down enough. Not really down enough, but that would be a better play than that. But I definitely appreciate the thought process and the idea there. I think there's just better ways to do it for you. Ibstock PLC, UK's largest house brick manufacturer. Okay. I don't know the UK's housing recovery as well as the US. So just because the US is going to recover doesn't mean that the UK is. The demographics are different. The immigration's different. I, U.S. The regulations are different. But if the balance sheet's healthy here, I think you probably got a shot at a double. So let's take a look. 149 million. Not a lot of cash there. Where's their assets? Property, plant, and equipment. Receivables. Yeah. 134 million. That's not life-threatening. 7.5 current. So you want to go in and find out how much of this stuff is going to mature over the next 5 years. And if it's not all front-loaded, this you also want to start to see turn positive, the free cash flow. Let's take a look on a quarterly basis. So it's down due to solvency risk. I don't think it's going to be a real risk, but this free cash flow, you got to have a plan for it to, looks like they were free cash flow positive last quarter. It was 1 and 2 that hurt them. So last 2 quarters, they've been free cash flow positive. Let's see what they've been doing. The shares they've been buying in. Not enough, but they're also not giving themselves a ton. It's a low return business historically, so you're basically just playing a price recovery. How long have they been around? 1825. Yeah, I think you probably could play this for maybe a double over the next 3 years. So I like the concept. Do some work and just see how they're going to reaccelerate growth. But I think you have done pretty good work there. Let's see, Mark Howard. I religiously follow you on YouTube. Value your insights greatly. Massive fan. Thank you very much. Grateful to have you. Invested in VF Corp and QXO, both doing amazing. So thank you very much. Tempted to buy more QXO due to the dip. Is there a particular reason for the dip? People thought that the acquisition price was pricey, but if it's cheaper than the money, if it's cheaper than the price at which you're raising the money, it's effectively, well, number one, it's accretive and it's almost free. You're like your own Fed. You just print currency, which is why there's huge value in having a public vehicle. Yeah, and typically the acquirer goes down and the acquiree goes up. So yeah, I think you're probably okay adding some here. Maybe wait for it if you could get it at a slightly better price. But it's going to be hard because with housing in the slump for the next few months, while I mean, if you could get it at 19 or 20, I think that's the right place. It's not going to hurt you for the long term to buy it here. Jasper Daniels, but he's running because now's the time to be a buyer. Okay, while housing is down, he's putting as many of these together as quickly as he can. Jasper Daniels saw a report today. Okay. This is Jasper Daniels. Saw a report today of top hedge funds based on 2025. We crushed that list, as a matter of fact. So equity long short. So yeah, thanks for sending that in. And over the last 3 years, you overlay, forget about the S&P 500, which we crushed. The HFRI we've destroyed. I mean, completely destroyed for 3 consecutive years plus. And it's not even in the same zip code. Neither the S&P nor the hedge fund index. So we're grateful for that, and we continue to work our asses off to make sure that continues every single year. Could you take a look at CNH Industrial ongoing buybacks, insider open market buys, CNH? Generally avoid companies that haven't been public long enough like this, but I'll just take a quick look at the numbers for you. The revenues have been kind of anemic since pre-COVID, so you'd want to see a turnaround there. They got $25 billion of debt. They bought in a lot of stock. What are they doing on a free cash flow basis? $1 billion of free cash flow, $25 billion of debt. Is that correct? I would find something else. Oh, long-term debt is $4 billion. What is this current liabilities at $16 billion? That makes no sense. That makes these numbers must be wrong. So just check out the balance sheet, because if they've got $16 billion of current liabilities, they're out of business, and it's not trading like they're going out of business. So for me, this one's a pass, David, just because it hasn't come down enough. Mike Costa, thoughts on SCL? Let's take a look. This is Stefan Company. Just turning free cash flow positive, had a tough run, must have been destocking, $500 million of debt. Margins are compressed. Shares, they didn't go crazy. What do they do? Intermediate chemicals, polymers and specialty products. Yeah, these chemical companies are starting to churn. Let's just see if the balance sheet is stable enough so you can stick around long enough for the thesis to play out. 100 million of cash, 388 of receivables, and 300 of debt. That's not terrible. $25 million of free cash flow. So they got to get the free cash flow going here. Revenues have just been flat, as has the rest of that industry as well. They've respected equity throughout this period. Stock-based comp, a little bit rich, but I generally like this. You just got to get comfortable around the turnaround, but I generally like this. Good work, Michael. Next is Panagiotis Natalis. Thank you for your opinion, not advice. Ask your opinion on PGNY. Okay, thank you for that. Okay, stock's down a lot. It's probably software, if I'm not mistaken, but let's just see what they do. They generate cash for a living. They buy in stock for a living. I bet this is software, which I'm not going to be able to have an edge on. And neither are you, by the way. No, I'm wrong about that. Provides fertility, family building, women's heart health benefits, different smart cycle treatment bundle, concierge style member support services, fertility specialists, integrated pharmacy benefit solution. This is such a niche type of thing that depends on government support. And that worries me a little bit. So you got to see how they get paid and how, if and how that's impaired. But I think this is pretty good. It certainly warrants doing more work for sure. I think you found something that definitely requires doing more work. But first thing that I would do is figure out what's the bear case? Why is everyone selling this? And then if you can get comfortable and feel like their worst fears are priced in, then there's something to do. But in this case, I think you got a healthy enough balance sheet to stick it through. And let's see what's happening with the income statement. Revenues are growing. Share counts in a little bit. Stock-based comp is out of control. So that's your problem there, is that they are giving themselves insane amounts of stock. So they're not really a partner. That's the only thing I really hate about this. I mean, what size is the business that they're giving themselves that much stock? They're generating 181 million of free cash flow. And then they're giving themselves $100 million of stock and buying in 100 million with your money. I hate that. They're destroying a good opportunity by being pigs. I think the better the business does, the more they're going to pay themselves, and you're going to be holding the bag. It's a shame because the operation itself has potential. So I think it'll work on a trading basis, but I wouldn't want to be partners with them. I mean, this is what's the market cap on this? $1 billion, and they're paying themselves $100 million a year in stock-based comp. That's piggy, man. I can't do it. Can't endorse it. If they would not be pigs, I think it's got huge potential, but all the great things they're going to do is going to accrue to them and not to their partners in any way. Stub. Bill says, I think you'd have no interest. That is correct, Bill. So I'll take a quick look about your questions about solvency risk and all that stuff. But for me, this goes kind of in the too hard box. What is it? What do they do here? Oh, live ticket events, StubHub. Oh, didn't Trump vote against this or make some rule against this? They're cracking down on these resellers. I mean, they're just a tax in the system. Got $1.2 billion of cash. You got $1.5 billion of debt with 1.2 current. Is that right? That seems a little bit crazy. So they'll have to refinance that. Generating 200 million of free cash flow. You might do okay with this, Bill. Just keep checking the moat on that. I don't know how much value add they actually provide, but apparently enough for the time being. Paul Lappin. So Paul says, university studying finance and learning about smart beta ETFs and strategies, weighting a portfolio based on factors, size, value, momentum, profitability. Basically a FAMA French model with additional factors to expand upon cap. I'm just curious your thoughts on multi-factor, smart beta investing, and whether you've looked at any of this stuff. Always interested in comparing academic topics with real world action. All the best. Yeah, you got to learn that just to understand what your competitors are thinking, but completely useless waste of time. Next, I'll tell you how I feel about it next week. But you got to go through it. That's what they're teaching. That's why they're teachers and not money managers. Alex Resnick. Question about the skew indicator, which, by the way, some of them are both, and some of them have experience, blah, blah, blah. Look, I mean, at the end of the day, well, let me put it this way. I'll put it in a better way. It's likely bullshit and will underperform, but they may raise $20 billion doing it. So, I'll be here outperforming out the wazoo and, probably have $3, $4, $5, $6 billion over time under management. And these guys will come up with bullshit fads and raise 40, 50 billion dollars until it blows up. It's just a different mindset. That's my goal has never been maximizing or optimizing AUM. My goal has been doing great work and enjoying what I do and enjoying the people I do it for, which is why every single client, 100 plus people, well over 100 now, that have come in, every single one of them has had a one-on-one phone call with me before they were brought in as clients. And there have been quite a number of them that have come in, and I've just urged them to spend another year listening to the podcast because they didn't get it. They were looking for short-term quick fixes, and you could tell they hadn't done any work. I want partners who are aligned with the framework that are going to be partners for life, not someone that's going to be in for a quarter and daily checking their P&L daily and day trading around it and all that stuff. So the answer to your question is yeah, learn all of that. You got to learn it all. But as far as if your interest is outperformance, that stuff is going to be short-term arbed away. If you think about private equity and public markets and owning good businesses at great prices, that's where you get your edge. But no one's willing to do it. And Bezos asked Buffett, what you do is pretty simple. Why doesn't everyone do it? And Buffett said, because no one wants to get rich slow. And it's kind of a joke, but if you look at his performance numbers from the partnership days, they're great. But if you're trying to turn 100,000 into 10 million in 5 years, then Buffett wasn't the type of manager for you. If you're looking to double your money every few years, then it's a great strategy. So, and the ones that are looking to turn the 500,000 into 10 million in 5 years, they usually wind up with zero. And then, 1 out of 100 actually does it. And then everyone chases them in after the move's already happened and they wind up with zero. So that's all I could say about that. Question about skew indexed. How do you interpret this? It's kind of middle range right now. It's not an extreme. Sam Benamo. Love your podcast. Discover it from a friend who was talking to a few months ago about PayPal, and he told me to check out your channel. Haven't missed an episode since. Well, welcome to the fold, Samuel. What do you think about Zoetis? Let's take a look. I think Zoetis is fine. It's been dead money for a while, if I'm not mistaken. Yeah. But I do think healthcare is turning, and this might be a good way to play it for you. Yeah, I got no problem with this one. Good work. You're a quick study, Samuel. Okay. Next. Loam Van Dam. Hey, Tom, keep it up. Love the podcast. 1, what do you think of PayPal class action lawsuit? 2, would you consider participating in this? No. So every company that makes money is going to have ambulance chaser lawyers filing stupid lawsuits from time to time. They're absolutely meaningless. They have nothing to do with it. Maybe they'll get a couple $1,000,000, which is a rounding error for PayPal, but they're just a tax on the system because our legal system allows for that. We just need to switch to a loser pays so these grifters can go do something productive, like be greeters at Walmart. But for now, they exist, and that's not changing. So no, I wouldn't participate in it, number one, because you're just taking money from yourself. And number two, they're not going to get very far. It's just a rounding error. It's cost of doing business. But good question, and thanks for asking. Ren Raby, Greg's, GRG. It's a supermarket, I guess. Supermarket business is a bad business, but let's just see how it looks. GRG. Free cash flow is inflecting. Share count's going up a little bit, but nothing egregious. Gross margins have been under pressure for 3 or 4 years, partially from inflation, I guess. What did they do? Food on the go retailer, fresh bakery products, sandwiches, and drinks. So this is a restaurant business. Been 1939. I do like the restaurant. What do they do here? Coffee, convenience. Oh, this is probably like a Casey's store. I think this one's going to be okay, Ben. Let me just check the balance sheet real quick. You got $500 million of debt. So just watch the balance sheet maturities. Generating 100 million of free cash. I don't really have a problem with this one. I think you're okay, Ben. So good job. GRG. L. Okay. Gosh, we got a lot this week. York Bourgeois, ENR. Energizer, yeah. There's just so much competition. I know they make some of the private label stuff, and Buffett bought Duracell or whatever it was, but this thing should be private. It's just been flat forever. I think from a trading standpoint, it's due to bounce. Maybe you could get a double, but how are they going to reaccelerate growth is what you're going to find out. Just take a look at the balance sheet for you. $214 million of cash, $3.2 billion of debt. I don't like that. They're not really, it's okay. Higher and better uses. You answered your own question with that one. Tom Timberland. He asked, do I go all in on Hormel and Diageo? We just buy more stock when we have availability to do so. And when these things turn, it's abrupt and it's quick. And they don't turn until they do. And then you make up, again, 10 years worth of returns in like 12 or 18 months. So we love these opportunities. Mosaic, Theo, we did this one a few times. I think those are ready to turn. I just don't think there's enough juice in it for us. But I do think you're generally okay on that one. But yeah, Diageo and Hormel, we just buy on red days. Mosaic, it's just such a cyclical business. It's like there's so many variables. You got to get commodities, farming. Balance sheet is a little bit, if I recall correctly, probably levered. But these are going to turn too. All the chemical and farming and yeah, $4 billion of debt, $270 million of cash, $1 billion of receivable, and free cash flow negative. I think there are higher and better uses of cash, Theo. Oh, that's an old question that never got deleted. Josh asked about Goodyear Tire. We said no. Napsters, no. Yeah, these are all old questions. KOF, bottling company. KOF. These are sleepers. No, certainly not at these levels. Robert Half. Yeah, so we covered all these. So that's it for now. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now, and thanks for tuning in. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.